Hotels like yours are looking for every edge to attract guests. Here's one, a completely immersive in-room experience. Introducing MovieBeam from Spectrum Enterprise. Right from their TVs, your guests can enjoy an in-room experience that entertains, engages, and informs. One that includes robust TV programming and interactive guest and concierge services. When you combine MovieBeam with our Fiber Connect Plus TV, your guests enjoy diverse entertainment options with up to 200 preferred channels, including sports and international programming, on-demand movies, Showtime content, and audio and video streaming apps. Guests can even cast content from their phones and tablets directly to the TV. Offer contactless interactions with up to 50 categories of guest and concierge services. Right from their in-room TV, guests can request housekeeping services, book a spa treatment, order in-room dining, view charges and use express checkout, and enjoy other services that you can customize. MovieBeam is also your central information hub. Display a personalized on-screen welcome message when guests enter their room. Communicate special announcements, promotions, and alerts about special attractions on and surrounding your property. And reinforce your brand with your logo, photos, videos, and more. MovieBeam paired with Fiber Connect Plus TV provides a highly reliable network connection that, unlike satellite-delivered programming, is not susceptible to weather-related disruptions. And Spectrum Enterprise stands behind MovieBeam with round-the-clock support and local account executives and technicians. It's entertaining, engaging, informing. The immersive in-room guest experience. That's MovieBeam from Spectrum Enterprise.
Hello, and welcome to Hotel Optimization Part 4. My name is Amy Vaxman, and I am Vice President of QuestX Hospitality. This week's virtual event, powered by Hotel Management and the International Hospitality Investment Forum, is the fourth virtual installment of our typically in-person hotel optimization event. We're really excited to hear about how the recovery is affecting the hotel industry and how properties are responding to the many changes that have been occurring lately in the world at large and in travel in particular. As always, we are partnering on hotel optimization with AHOA, which is continuing to advocate for its members and the hotel industry at large as the industry works its way through the recovery. In addition, today's sponsor, as you saw in the previous video, is Spectrum Enterprise. Thank you for your support. Cecil P. Staton, AHOA's president and CEO, is going to kick off our day with a few words. Cecil?
Hello, I'm AHOA President and CEO Cecil Staton. For more than a year, the COVID-19 pandemic has put hotels under a financial stress which is greater than what we witnessed after 9/11 or even the 2008 financial crisis. But we're a resilient industry, and I'm proud of how we've come together to face the crisis and lay the groundwork for recovery. Over the next 2 days, you're going to hear from industry experts who will discuss ways to address the lingering effects of the pandemic and strengthen your business around a number of areas. You'll get real, actionable advice from industry experts that you can use right away. Whether you're looking for the best financial deals or ways to make every dollar count, or perhaps you're looking for new technologies that will have the greatest impact upon your business, Hotel Optimization and AHOA are here to help you on the road to recovery. An optimistic public is itching to get back out there on the road again, and we're going to help you prepare to welcome them back to your properties. Over the past year, we saw how we came together as an industry. We're here for each other, and events like this will help us remain connected and equipped with the tools to help us revitalize hospitality.
Thanks, Cecil. Here is a quick schedule of today's events. Session 1, we are going to start with a hospitality update from STR and Lodging Econometrics. Session 2, the development scene, dirt, deals, and dollars, we will discuss whether now is the time to jump back into the hotel construction industry. Session 3, a look at tips for a leaner operation. Session 4, putting your space to work, a look at how to make every square inch of your hotel count. A few technical notes before we begin. If you would like to view the day's agenda, please click on the Agenda tab on the left side of your screen. If you miss any session, the event is being recorded and will be available on demand within 48 hours after the event concludes. Each panel will include a question and answer period, so please add your questions for the panelist on the left side of your screen in the Q&A tab. You will find it next to the Chat tab. In the same area on the left side of your screen, you will also find various handouts and resources from our sponsors. Before we begin the day, here is a poll from our sponsor, Spectrum Enterprises. Now, let's get started with our Kickoff Hospitality Snapshot, which is presented by J.P. Ford of Lodging Econometrics and Ali Hoyt of STR.
Good morning. Thank you for having me. It's great to be part of Hotel Optimization Road to Recovery. Today, I've been asked to provide some insight on the U.S. hotel construction pipeline. This presentation will concentrate mostly on the U.S. However, we will also take a look at some Asia Pacific and Europe hotel construction numbers as well. So, without further ado, let's get started. We're going to start right here on slide 3. And what I'd like for people to focus in on here is these are the U.S. lodging real estate stats for the past 4 quarters, above the solid line in the middle of the slide. And you can see that at the top, at Q1 21, the U.S. hotel construction pipeline stood at 4,967 projects, 622,218 rooms. And if you drop your eyes into the next line, you can get all of the stats for Q4 20, Q3 20, Q2 20. So you can see the decline in the pipeline since the second quarter of 20, all COVID pandemic related. And over that period of time, we've lost about 615 projects and 65,583 rooms out of the pipeline since the close of the second quarter of 20. Below the line, you can see that the peak in this real estate cycle for hotel development was really at the end of the fourth quarter of 2019, where we had 5,748 projects, 708,000, almost 709,000 rooms. Now, comparing this peak to the last peak, which was in the second quarter of 08, we didn't quite reach it in terms of number of projects nor the number of rooms, but nevertheless, extremely solid and packed pipeline. And then the other point I want to make is that you can see the last line. It says last cycle bottom was in Q1 12. That is all part of the 08, 09 financial Great Recession, whatever you want to call it. And you can see that the pipeline at that point literally fell by more than 50%. And that has not happened this time, which is very, very good. People have really taken a wait and see attitude about how the pandemic was going to roll out, when vaccines were going to start. So there was no great fall off in the pipeline, although we did lose some projects to cancellations and postponements. This is a slide that we've been running for a couple of years now, and I always like to update it for everybody. This shows all the new brand announcements since January of 2015. And if you count them, you'll see that there's been a total of 115 total new brands since 2015. Everyone's aware that we have exploded with new brands over the past 5-6 years. And the other point I want to make with this too is that all the brands that you see highlighted are brands that have been announced just in the last 6 months during COVID, during the pandemic. And anything you see that's darkened type print, those are established international brands that have announced U.S. growth plans as well. So a ton of new brands broken out for you by chain scale. This slide shows the U.S. construction pipeline by project and rooms. And you can see down at the bottom, those are year-end close numbers, 2015, 16, 17, 18, 19, and 20. And you can see the growth in the pipeline coming out of the Great Recession. And then you can see topping off at the end of 2019 and just a little bit of a tick downward at the close of Q1 20. And like we talked about a moment ago, you can see that at the end of 20, we ended up with 651,000 rooms in the pipeline. At the end of the first quarter of 21, there was a further drop and 622,000 rooms in the pipeline, 4,967 projects. The other thing I want to point out this as well, with these stacks, you can see they're all color coded. So the dark blue are those that are under construction, grays are those projects that are going to start in the next 12 months, and the lighter gray, those projects that are in the early planning process. Okay, U.S. construction pipeline by project stage, year over year. This is showing you the pipeline by the 3 project stages that we track down the left-hand side. Under construction, start in the next 12 months in early planning, and then totaled at the line at the bottom. This is all COVID. It's from the end of the first quarter of 2020 to the end of the first quarter of 2021. And you can see the declines for those projects that are under construction. Those are going to start in the next 12 months. However, you can also see that projects that are in the early planning stage are up 10% by projects, 14% by rooms. It's a good sign. Talk about the road to recovery, the road for recovery. We can see that the back end of the pipeline is starting to fill in again. This is a similar slide, but a quarter over quarter view. So this is showing Q4 20 to Q1 21. And the point to be made here is that there was additional fall off in the pipeline in the first quarter of 21, just as vaccines were getting ramped up and being distributed throughout the country. This is the U.S. construction pipeline by chain scale. Okay, you can see it starts at the top, luxury, all the way down to economy. And then we've also broken out unbranded and casino projects and rooms as well. And then you have the totals at the bottom. The interesting thing about this particular slide is that since the end of the third quarter of 2020, you can see that the pipeline has actually increased the luxury end and at the economy end, those 2 chain scales. I can tell you that the increase is primarily incremental. No great shakes there, but interesting to note anyway. And the other point to be made as well, as it relates to upscale and upper mid-scale chain scales, you can see that most of the projects in the pipeline are in those chain scales. That's been the case for many, many years coming out of the Great Recession. You're all familiar with many of the brands that are in those particular chain scales, and those are the brands that have been developed, have been built, have opened across the United States, and have been the favored brands of many developers over the past 10 years. All right, everybody wants to know forecasts. Here's our forecast for new hotel openings. Any bar that you see in blue is actual. You can see the 2018, 2019, 2020 number of room openings. You can see that for 21, We had 27,528 rooms open in the first quarter. We're forecasting almost 82,000 additional rooms in the remaining 3 quarters of 21. And what's interesting to note here is that we had a tremendous amount of new rooms open in the first quarter of 21, 27,528. And I did some comparison. I looked back to how many rooms the industry opened in the United States in the first quarter of 2020, and we only opened 16,300. So to see that jump is quite nice. It's favorable, and I think it bodes well for new hotel development moving forward. And final point, growth rate at the end of this year, we're projecting 2.0%, and the same for 2022. All based on developer sentiment, all based on projects that are in the pipeline, forecasted start dates, and forecasted opening dates. Okay, moving on. This is the forecast by chain scale. Another slide that people like to see. They like to know the number of projects and the number of rooms that are forecasted to open going forward for the next couple of years by chain scale, and what those particular growth rates are. Again, to reiterate, upscale and upper mid-scale, you could see have the highest growth rates, 4.0 for 2021 forecasted, and 3.2 for upper mid-scale forecasted, and right around those same numbers for 2022 as well. U.S. construction pipeline, another point that people are, investors, developers are very interested in is what's branded and what's unbranded in the pipeline. So this chart really breaks that out and provides that comparison. On the left-hand side, you can see under construction start in the next 12 months in early planning, the 3 project stages, as you know, that we follow. And then you have the branded and unbranded project and room counts at Q1 21 in those particular project stages, and compared to Q1 2020. And then you can see the variances over to the right-hand side. And as we talked about earlier, early planning is the project stage where we've seen growth over the past number of months. And you can see those numbers are in the black, while the others are still in the red. Okay, construction pipeline. Top markets by census room counts. What we've done here is we've taken the top 25 markets in the country, and markets generally considered 26 to 50 in the country, and then the rest of the country, and given you the pipeline for projects and for rooms. Point to be made here is you can see that pretty significant number of projects and rooms are being developed in the top 50 markets in the United States. And just to give you some stats on that, 54% of the pipeline by projects is concentrated in the top 50 markets of the country. And just about 60% of the pipeline by rooms is concentrated in the top 50 markets in the country. So there's a lot of demand to be in those favored cities, top 50 markets. And then you can see that other markets, which is essentially the rest of the United States, 2,290 projects and a little over 252,000 rooms. U.S. construction pipeline by top markets in the United States. So you see the top 6 markets down the left-hand side of this page: New York, Los Angeles, Atlanta, Orlando, Dallas, Nashville. And then you can see their pipelines from both a project and room perspective in compared to Q1 2020. So I guess the point to be made here is that although we've lost projects because of this pandemic, to cancellations and postponements, and those projects that have gone on hold as well, but not significantly in these top markets. So these top markets still have pretty strong pipelines. And that is witnessed by the fact that the blue column, which is the number of pipeline rooms as a percentage of the Q1 21 census meaning open and operating hotels. So you can see that New York market has a pipeline of rooms of 24,762. That represents 20.6% of the total number of open and operating rooms in the New York market right now. So pretty strong supply numbers for each of these markets. And these markets have been roughly at the top over the past 5 or 6 years as well. Okay. Development pipeline, parent companies. This is new construction, but it's also conversions into their brand families as well. And you can see that Marriott International at the end of the first quarter of 21, 1,429 projects, and what their pipeline looked like at the end of Q1 2020. And you can see that they're down 208 projects, and that's a combination of new builds and conversions. Hilton's down 181, Intercon's down 150. Not surprising. These companies have some of the most favored brands within the industry, and due to cancellations and postponements, we certainly expected that their pipelines would have declined. All right, this is just a similar slide, but a comparison from the end of 2020 to the end of the first quarter of 21, and you can see further decline, not significant or rather minimal, but just a recognition of some of those projects that have moved out of the pipeline for these 5 parent companies. All right, so I want to show a couple of slides and take you through a little bit of a global perspective and talk a little bit about the global construction pipeline by region. And we've used 4 different regions here. We have the United States, the other Americas, would be Canada and South America, EMEA, Europe, Middle East, Africa, and Asia Pacific. Down the left-hand side, you can see the project stages under construction start in the next 12 months, and early planning, which we've grouped together, and then a total pipeline comparison. This is all spring of 20 versus spring of 21. You could see all the red numbers. I don't think this is much of a shock to anybody. Pipelines around the world are down, except in EMEA. They are up a little bit in terms of the number of projects that are under construction, up 9% in projects, 6% by rooms. So a good sign. We'll see what happens in the second quarter. Little too early to judge right now. The key is obviously getting people vaccinated and getting the rest of the world opened up, like the United States is doing right now. Okay, a little tour of Asia Pacific. These are the top 5 countries, quarter over quarter, by the number of rooms in their pipeline. Not surprising. At the end of 2020 compared to the end of the first quarter of 21, China is actually up in terms of number of projects, number of rooms, as is Vietnam. Indonesia and Malaysia down just a hair. India way up. Again, it'll be interesting to take a look at the second quarter to see where India's pipeline is at that time and at the end of the third quarter, given all of the trouble that they're having over there due to the pandemic. Now we'll take a look at the cities within the Asia Pacific region, and cities with the largest pipelines are all in China: Chengdu, Guangzhou, Shanghai. And this has pretty much been the same over the past couple of years. These are just the cities in China that have the strongest pipelines, strongest demand, and hence pretty healthy supply numbers moving forward. Okay, similar tour of Europe. Top 5 countries in Europe with the strongest pipelines: the UK, Germany, Russia, France, and Portugal. What's new here is Portugal. Over the past year and a half, their pipeline is significantly strengthened. France, Russia, Germany, and the UK have been the stalwarts in terms of the strengths of their pipeline over the past couple of years. Germany's down a little bit, UK's even, Russia's up, France down a little bit, Portugal just down a hair as well. Now we're going to take a look at top 5 cities in Europe with the strongest pipelines: London, Dusseldorf, Moscow, Hamburg, and Berlin. Again, up and down a little bit, but these have typically been the top 5 European cities that have had the strongest pipelines over the past 6 to 9 months. Let's talk this one particular slide about transactions, and I should note these are transactions with a reported selling price. And you can see the bar chart. The blue represents those hotels that have sold greater than 200 rooms, and the orange is those hotels that have sold less than 200 rooms, and this is average selling price per room. You can see a spike at the end of 2020 into the first quarter of 2021. It's rather unusual, and since there are only 7 sales for those hotels greater than 200 rooms, we haven't been able to form any trend on that yet. But I think what is interesting and what's of note here is that you can see that the total transactions down at the bottom have been trending downward since the end of 2015. And what I might say is pretty significantly. There was very little transaction activity in 2020, and there was very little in the first quarter of 2021. We'll wait and see what the second, third, and fourth quarter of 21 holds for transactions and average selling prices on a per room basis. Okay, a little balance sheet here. U.S. lodging real estate total investment by dollars as buyers and as sellers, and we've broken down into 3 different tiers here: privately held companies, equity funds, hotel companies, individual owners, and then publicly held companies, REITs, hotel companies, and all other entities. And you can see that the activity in 2020 was way off compared to 2019. And again, off to a slow start in 2021. But I think as everyone gets vaccinated and the country continues to open up, you're going to see these numbers change. Some takeaways. Pipeline is off again in the first quarter of 21 compared to Q4 of 20. That's due to hotel openings that have exited the pipeline, some residual cancellations and postponements, fewer signings at the franchise level as well. We talked earlier about the fact that there's been a slew of new rooms that have opened in the first quarter of 2021, and we expect more to open and actually get us to a 2% supply growth rate by the end of 2020. Also talked about many markets that have relatively strong pipelines. I think what we're beginning to see is the Fly-To conference travel is back, expected to ramp up in the second half of this year. Many of the conferences, both industry and hotel vendor related, have all been pushed back into the second half of 21. One of the things we didn't talk about, but everyone should be aware of, there's a lot of renovation and conversion activity right now within the industry in the United States. Transaction activity, from my perspective, really has never been as low as it is right now. And hopefully that turns around. And I think the key to getting back to pre-COVID times is getting everyone vaccinated just as quickly as we can, and getting the rest of the world vaccinated as well. So I want to thank you for your time here this morning, and to Hotel Optimization, the Road for Recovery. Thank you all, and enjoy the conference.
Thanks so much, everyone, for joining us here today. It's a pleasure to be together virtually and hopefully in person again very soon. My name is Allie Hoyt, and I'm the Senior Director of Consulting at STR. Today we're going to talk about hotel performance across the U.S. hotel industry. We'll look a little bit at what happened over the past year of the pandemic, where is the industry now, and then what can we expect in the recovery over the next few years. The COVID-19 pandemic gave us a very different set of data to look at than we've ever seen before. 1 year and now 1 year plus into the pandemic, where are we now? I thought it would be helpful to start first with a slide looking at the entire world. This will mostly talk about the US performance, but in terms of the rest of the world and perspective, this is helpful to frame our understanding. Here we're looking at RevPAR performance indexed to 2019. And if you've heard from STR recently, or you will in the future, you'll hear us talk about indexing. And that's what we're going to be doing for the rest of this year to make sense of 2021 performance. The percent changes off of last year of 2020 pandemic performance, it's a little hard to make sense of those percent changes when we're seeing 30, 40, 100% change. So we're going to look back to 2019, to the same month, and index to get a sense of how we are approaching that prior peak of performance. So here when we look at RevPAR performance indexed to 2019, the US is about 70% of, this is for April of 2021, at about 70% of April 2019 performance. The lighter purple circles show us RevPAR performance based on our new total room inventory methodology. And that's something we created last year as a way to look at the entire sample of hotel rooms in a market. Whether they are open and closed or closed, we're using those in the supply number when we calculate occupancy and RevPAR to get a better understanding of those true performance levels. So in an area like Europe, where there are still a fair number of closures, that total room inventory RevPAR number will be lower than our standard methodology. The US sits just behind mainland China, Australia, and New Zealand in terms of recovery to 2019. And those areas, China, Australia, and New Zealand, have done an excellent job, even prior to significant rollout of the vaccine, of controlling the virus, and therefore are further along in their recovery. For the US performance, this is 12-month moving average for April of 2021. You'll see that 2019 index over on the right-hand side. Occupancy and demand really starting to improve now as we head towards the summer months at about 68% of 2019 levels. Rate at about 75%, and annualized RevPAR more than halfway back to 2019 levels, which is encouraging to see after the very steep declines across all of these key performance indicators we saw in 2020. Occupancy on a weekly basis for the week ending May 15th is the highest that we have seen since the start of the pandemic. So another very encouraging sign, a 59.1% occupancy is great to see at this point in the year. We've also been tracking vaccinations and how that relates to hotel demand. Here we're looking at weekly hotel demand indexed to 2019, and then overlaying the number of people in the US that have been vaccinated with at least one dose. So here we're seeing that demand has been stabilized around that 80% index when we look compared to 2019, fairly stable, mostly driven by leisure travel. The number of vaccinated people in the US has been increasing, not quite at the rates that we saw in February and March as the vaccine programs were being rolled out, but still over half of the US population has been vaccinated, and that bodes very well for summer travel. Speaking of summer travel, and a lot of us then think about air travel, we've also been tracking room demand data compared to the number of people who are going through TSA checkpoints. Now, this is publicly available data that has been a really helpful indicator of how many people are flying and what does that mean for the hotel industry. So here we indexed room demand to 2019, as well as TSA screening numbers to the same week in 2019. Room demand we have seen at about 80% of 2019 levels, and TSA screenings at about 60% of 2019. We then also look at that as a ratio. So we're trying to understand for all of the room demand, how much of that room demand comes from travelers who are getting to a hotel by an airplane. Pre-pandemic, on the left-hand side of this chart, that was about 60% of the demand for hotels came from air travel. Very low levels at the beginning of the pandemic. That was roughly 10%. So there were not very many people traveling and staying in hotels that were traveling by air. We're now back up to about 50%. So we're seeing the recovery in these metrics as well. Occupancy on a weekly basis is only 11.6%, percentage points compared to the same week in 2019. So this is very encouraging to see these higher levels of occupancy returning to the industry, a very welcome sign for every single hotelier. As we move through the rest of this year and into the recovery, we wanted to have a way to track all of the markets in the US. The pandemic unfolded very differently depending on where you were in the US and even the world. And now the recovery is also going to be different depending on the area. We came up with these 4 different phases to classify markets as we move through the recovery. The first is depression. This is looking at current RevPAR performance compared to the same period in 2019. If that RevPAR performance is less than 50% of those 2019 numbers, that market is classified as being in a depression. Recession would be 50 to 80% performance, recovery 80 to 100, and then peak is any market that is already performing above their 2019 performance. With the most current weekly data, we're encouraged to see a fewer number of markets in that depression phase and then more moving into the recovery and peak. Over half of markets in that recovery and peak phase, so over 80% to their 2019 performance. Some of those markets that are still in that depression phase are the top 25 markets. These are large urban markets that rely on group business and corporate travel. These markets have been hit very hard. As we've seen leisure travel come back, it hasn't been quite the same story for the top 25 markets. But we are now starting to see some of those occupancy gains. Here we're looking at 2019 occupancy in gray compared to 2021 occupancy in teal. At the top of the chart, Miami and Tampa, those are 2 Florida markets who have been performing very well throughout the pandemic with strong leisure travel, spring break. The weather is very nice. There's a lot of hotels open and ready for travelers to stay there. On the lower end of this chart, those markets that aren't performing quite as strong compared to their 2019 occupancy, these are some of those very group-reliant markets. Areas like Seattle, Chicago, Boston, DC, San Francisco. And these markets still also have a fair number of full-service hotels that remain temporarily closed. So these are upper upscale and luxury hotels that cater to corporate travelers and group meetings with a lot of meeting space that haven't been able to reopen yet until we see more of that business return. And I want to end this section, this first section, with looking at profitability data. This is a relatively new data set for STR. We've always collected annual data, and last year we started releasing monthly profitability performance, which was the perfect time to be able to look at the recovery not only in terms of RevPAR, but going down to gross operating profit, total labor, food and beverage, and really be able to understand what's happening in the industry. This is monthly performance indexed to 2019 for demand, total revenue, gross operating profit, EBITDA, and total labor. So you'll see for gross operating profit on this slide, as demand has increased over the past few months and gotten closer to 2019 performance, we're seeing gross operating profit, which is the blue line on this chart, increase a little faster than we expected. Looking at the data from April and May of last year, things were very bleak in terms of profitability for hotels. And we're now seeing that gross operating profit is at about 60% of 2019 performance. And we're encouraged to see that number continue to grow. We've also done an analysis of looking at what it takes for a hotel to break even. That was a common question early last year into the pandemic as operators are deciding, are we staying open? Do we need to close our doors? What makes the most sense for our business? Right now, that occupancy break-even point is about a 50% occupancy for both full-service and limited-service hotels. Prior to the pandemic, at the top of this slide and chart is the percentage of hotels that break even on a monthly basis. And prior to the pandemic, this is not typically something that we would be talking about or all that worried about, with over 90% of hotels breaking even on a monthly basis. April and May, 4%, 30% of hotels breaking even, very low levels of performance. Now into 2021, we've seen significant increases in the number of hotels that have been able to turn a profit month over month. And now for April, back to those pre-pandemic levels of 92% of hotels breaking even. For net income, there aren't as many hotels that are breaking even for net income. Once we take out those fixed costs, that's typically around 75-80% of hotels breaking even. And for April 2021, that was 61% of hotels. So how did we get here? That's a snapshot of where we are right now. What happened in 2021 and, in 2020, and what did that success depend on? And there's really three things that we'll look at in this next set of slides. First, hotel type and the variances in performance by the type of hotel. Location, urban versus airport or resort locations. And then finally, demand generators, group versus transient business. So first, let's look at hotel type. We classify hotels at STR with economy class all the way up to luxury class hotels. Economy and mid-scale, those limited service hotels in the lower chain scales did better throughout the pandemic. We saw higher performances of occupancy and rate relative to 2019 in those lower tiered hotels. And they continue to perform, that's 95 to 100% in both occupancy and rate relative to 2019. Looking ahead to the upper tier hotels, upper upscale and luxury hotels, you'll see much lower levels of occupancy, 56 to 62% of 2019 levels of occupancy. Now, luxury hotels are one that stand out on this chart as there's not as many travelers staying in luxury hotels, but they are paying higher rates than 2019. So there is some pricing power still. Overall RevPAR is still down with that decrease in occupancy, but rate performance is still fairly strong in those upper tier hotels. This is that same category for the recovery, those four areas of depression, recession, recovery, and peak. And here we did it based on hotel size to look at the differences in room counts by hotel. So the small hotels on this chart are clearly the winners of the past year. Over 70% of small hotels are in the recovery or peak phases, meaning they are now 80% or greater of their 2019 performance. Large hotels are suffering more than these other groups of hotels based on size, given those dynamics we talked about before of a lot of meeting space depending on group travel, corporate demand, and a lot still remain closed. Large hotels, about 60% remain in the depression phase. A lot of those large hotels also happen to be in urban areas, a lot of those top 25 markets. So we're seeing a higher number of urban hotels, over 40% still at or below 50% of their 2019 performance. The winners on this chart, small metro town location types, interstate and resort location types with over 60 to 70% of hotels in those location types back to or close to their 2019 performance. So the recovery really is going to differ as based on where a hotel is, its size, a lot of different factors as we head through the next few years. And finally, just to touch on segmentation data, this is transient rate compared to group rate, both indexed to 2019. Transient rates, we've seen a steady climb in the index for transient rates, now back to what we would consider a normal range, about 94% of 2019 performance. Group rates are about 76%, but there isn't as much group demand right now. Group demand really hasn't started its recovery, so this group rate isn't as important to the conversation right now. This is traditional with what we've seen in past recoveries, with transient demand really leading the way and group lagging in the recovery. This chart is transient RevPAR and group RevPAR index to 2019. You'll see that steady increase in transient RevPAR in its relationship to 2019 performance, and that group RevPAR has been fairly steady and performing at very low levels and really hasn't started a significant recovery. We'll look at that in a little bit more detail here next in our forecast. So now let's talk about 2021, the rest of this year and beyond, as we look through the next couple of years and what's going to happen in the recovery. This is a new chart that we've started including, and we get this question a lot of what's going to happen with business and leisure and group. We work with Tourism Economics as our partner when we do our U.S. forecast. They're providing the economic data and all of their insights. We're providing the hotel data, marrying those together to arrive at our forecast for the total U.S. And this is what goes into that forecast, is our expectations for how business and leisure and group are going to perform. The line on the top with the darker dots is leisure demand. And when we look at leisure demand, and you see on the bottom Q1 in 2021 and Q2, very strong leisure performance. That's what we're seeing right now, that leisure performance is stronger than ever and is truly back and beyond 2019 performance. We see that quick uptick in leisure performance as travelers in the US were vaccinated and then are ready to travel. The CDC is relaxing guidelines. We see that quick response in the US leisure traveler to want to get back out and stay in hotels. Business is the dashed line, and business travel takes a little bit longer. We're not expecting closer to the end of this year that business demand will really continue to grow. We're seeing steady growth on weekday performance, but really not in earnest until the end of this year into 2022 for business travel. And a similar trend for group in that long group booking window, the unique characteristics of this health crisis and not being able to gather in large groups has really led to low levels of group demand, and it will take longer for those groups to rebook their events and get back out and travel. So you'll see into 2022 that group demand is really starting to make a comeback. That all folds into our 2021 forecast. We have 2020 actuals on this slide, and for 2021, pretty significant gains in all three metrics, occupancy, rate, and RevPAR for this year. We're forecasting to end this year just over a 50% occupancy, $109 rate, and a $58 RevPAR. We did, when we revised this forecast earlier in May, we did up this forecast a little bit given how demand has been outperforming our expectations. So we revised this upward a little bit at the beginning of May. Now, while these are larger gains off of 2020, it's important to highlight here, as I've done throughout the presentation, back to 2019, that these levels, even though they are growing over 2020, not returning to 2019 levels just yet. Here are the key three metrics, demand, rate, and RevPAR, all indexed to 2019 performance for the next 3 years. You'll see demand is the first to return to 2019 levels by 2023. And then we see rate and therefore RevPAR following after that demand and occupancy recovery. So it's not really until 2024 that we will see rate and RevPAR return to 2019 levels. So it's still going to be a multi-year recovery for the hotel industry, but we're very optimistic at the trends we're seeing now. And once we continue to see increased business demand and group demand, that will help push the industry occupancy, rate, and RevPAR levels further and further closer to those 2019 performance levels. Thanks so much for joining us here today. This presentation will be available to attendees, and please reach out with any questions that we might be able to answer at any time. And thank you so much.
Thank you. That was a great presentation. Hopefully everyone has a better sense of where performance stands. Before we begin panel 2, we have a 5-minute break sponsored by Jackaruso Enterprises.
The pandemic has been devastating to our industry, but we've learned that we are resilient. We see you stepping up to the challenge. We see you working longer hours. We see you going above and beyond. And you've inspired us to do more, work even harder. We are a team of hotel experts who are passionate about sales. The service we provide gives hotels all the benefits of an on-site salesperson for less than half the cost. So, while you were folding towels, helping guests, and working night audit, we were finding essential travelers, rebooking groups, setting up new accounts, and responding to every single lead. Throughout the shutdown, we found an additional $22 million in revenue for our hotels, helping them keep staff employed and keep their doors open. We did it for them, and we can do it for you. Learn how we can help your hotel with remote sales service. The pandemic has been devastating to our industry, but we've learned that we are resilient. We see you stepping up to the challenge. We see you working longer hours. We see you going above and beyond. And you've inspired us to do more, work even harder. We are a team of hotel experts who are passionate about sales. The service we provide gives hotels all the benefits of an on-site salesperson for less than half the cost. So, while you were folding towels, helping guests, and working night audit, we were finding essential travelers, rebooking groups, setting up new accounts, and responding to every single lead. Throughout the shutdown, we found an additional $22 million in revenue for our hotels, helping them keep staff employed and keep their doors open. We did it for them, and we can do it for you. Learn how we can help your hotel with remote sales service.
Welcome back. The development scene, Dirt, Deals, and Dollars, is next, and it's moderated by Daniel Lesser, President and CEO of LW Hospitality Advisors. Please don't forget to add your questions to the Q&A tab on the left side of your screen.
Dan, I can't hear you. Okay, now I can.
Can you hear me now?
Yep. Yeah.
Okay, great. Well, good morning, everybody. I'm Daniel Lesser, President and CEO of LW Hospitality Advisors. And we're just going to go around real quick and provide name, rank, serial number. If anybody's interested in any of our backgrounds, please go online and check out our backgrounds. Great. Biren, you want to say hello?
Yeah, good morning. Thank you, Daniel. Thank you to Questex Hospitality and Hotel Management for having me. My name is Biren Patel. I'm the chairman of AHOA, which is the largest owners association in the world. Thank you for having me again.
I guess I'll go clockwise.
Go ahead,
hi. Yeah. Hi, this is Youngmin Park. I'm with VP of Acquisitions at Hersha Hospitality Management. Just excited to be here.
Great. Thank you. Mitchell, last but not least.
Appreciate it. Thanks. Good morning, everybody. Mitch Salomon from IHG Hotels and Resorts, VP of Development.
Great. Okay, so we have a fairly extensive number of questions that we'd like to go through with the panel. We don't probably have enough time to get to all of them, but just real quick, sort of setting a backdrop, if you will. Listen, everybody knows this is nothing new, right? The lodging industry has been one of the hardest hit sectors by the coronavirus pandemic, and given the widespread reduction of corporate group and leisure travel, across the United States, obviously had an immediate, devastating and swift impact on the sector. And the industry metrics, fundamentals are rapidly increasing, right? But like prior downturns, many anticipate that from a financial perspective, distress is going to continue for quite some time and produce further loan defaults and, frankly, actions by special services that they've been holding off on for now. That's the bad news, right? The good news is that, having recovered from prior economic and demand shocks, America's hotel industry has a proven track record of resiliency. Past downturns, no matter how painful, they've always been followed by records during which new highs were achieved for both profits and property values. So the outlook is, based on history, fairly bright. The fact is that over a long-term basis, lodging investments, this is again proven, they offer superior risk-adjusted returns when compared to other investment classes that are focused on value-add opportunities. So with that as a backdrop, I'd like to go through and sort of have everybody weigh in on this first question. We hear about returning to normal, right? New normal, normal. Why don't we just go around the horn real quick and give me a sense as to, what do you see as we're coming out of this devastating event? Byron, you want to start?
Yeah. So I think that there's definitely optimism for the future. As STR and the previous presenter mentioned, there's continued growth in the pipeline. And, Americans are ready to travel again. As societies are evolving, I think so will hotels. Consumer confidence is growing day by day as people are getting vaccinated. And for the most part, occupancy rates are increasing. And it seems like this, as we're coming into the summer months, the leisure travel and all those markets are coming up even more. And so I think that we're in line for a decent year.
Young Ben.
Sure. Yeah, I echo the same sentiments. I think the recovery for especially 2021 is a lot better than expected. The only hesitation I have is that I think there's still like 10 to 20% of the population that, even with the latest guidance, they are still going to stick to their old they're still going to be extra cautious. They haven't had the, they haven't been pushed to sort of like dip their toe in the water, even after they're vaccinated. So I still think that until that 10 to 20% of the population gets comfortable, which I don't see for another, I don't know when that will be, but that will hold back pretty much getting back to normal, especially if, corporate travel and groups, they still have to be cognizant of the sensitivities of that population.
Great, thank you. Mitchell.
Dan, I'm an optimistic guy. I guess that's a typical trait of a development guy out of in the franchise business. But I spent the past, about 10 months during the pandemic traveling to as many of the hotels as I could within my territory. I probably hit about 90% of the hotels, which has been really a great experience for me. I had a great opportunity to meet with a lot of great owners and a lot of great general managers. And kind of what I saw was, the recovery started, following the sun line. I'm based up in the Northeast, and my hotels down south kind of started seeing it first, and then it's bled up through the coast. So, I think it's been positive. Every time I turn on CNBC or listen to, the presentations earlier, or even see some stuff in the news and the different rags regarding, how well we saw during Memorial Day weekend with strong occupancies. All those things to me look like they're positive signs in the right direction. Now, I know we're not where we want to be, but I definitely feel that it's come back quicker than what's come back has come back quicker than I anticipated. So again, I'm optimistic, and I feel that our industry has a lot of pent up demand, and looking forward to seeing everyone out there on the road and in our hotels.
That's great. I think it's fair to say that pretty much everybody, the whole sector, I mean, if you're in the lodging industry, you have to be an optimist, right? If you think and act negatively, you're not going to have a whole lot of company, right?
No.
Yeah. So anyway, yeah. Let's drill down a little bit further in terms of, hotel property type, and let's mix in markets as well, because we all know that it's not going to be an even recovery, right? So, maybe one of you can jump in and talk about, select serve versus resorts and everything in between. And then let's talk about, some of the major urban markets, which are, were formerly the darlings of the sector and are clearly challenged right now. Mitch, you raised your hand.
Yeah, I'll start on this one since my esteemed colleagues went first on the last the intro in this one.
I like that.
I work in limited service, and that's my primary background and experience. So I could definitely talk about where they've done, but what we're seeing specifically is talk about markets, drive-in markets, leisure markets have performed very, very well. I'd heard that, in a market like Niagara Falls, although impacted by the international travel that's not coming in through Canada, had their first positive January since I can remember, which is fantastic. You got other markets like Lake George, Lake Placid, ones like that in the Northeast, these drive-in markets that, performed fairly well, performed okay throughout the pandemic, and have definitely seen an uptick in these warmer months as folks are looking to travel. So that's been very positive from a market perspective. From a demand perspective, my extended stay properties, those are the ones that seem to do really well through the pandemic in comparison to its counterparts. And then even still now going forward, that's where I'm seeing the demand, not only from a consumer perspective, but also from a development perspective. I had an owner talk to me yesterday about potential of 5 years plus of demand that he's trying to fill in an extended stay market that he doesn't have a product to support. So it's things like that are the reasons why I'm optimistic. I think, as you go up the chain scale, I think there's definitely some challenges with full service hotels, luxury hotels, and especially hotels, in major metro markets. I've seen the devastation that hit New York City. I've been walking through the city a couple times during the pandemic and recently, and saw people coming back to offices, which is, fantastic, sitting in Bryant Park, which is fantastic. But, the demand at that corporate level is, as we all know, still significantly impacted.
It's interesting in my practice, when the pandemic hit, call it March 15th of 2020, we had a fairly robust pipeline of feasibility work, if you will. Some of that terminated, right after, call it March 15th, right? But it was interesting as we went through this pandemic, we always had a feasibility project going on, and now we have a whole slew of them going on, and it's built up over time, which is really kind of interesting. Biren, you want to weigh in on? By the way, Mitchell, I have a question for you. Are you optimistic?
I'm a little optimistic. I got 2 thumbs up.
Biren, why don't you weigh in on what you're seeing, in the different sub-segments within the lodging sector?
I think Mitchell covered a lot of it, but yeah, during the pandemic, not to just echo what he said, the extended stay and economy segments continue to be stable. I think that, here as we're in the summer months, leisure travel continues to pick up. But the key question, I think, for the entire industry is, when is corporate travel going to pick up, right? Until corporate travel picks up, the industry isn't back to anywhere near pre-pandemic numbers. And we're hoping that by the fall, that as companies are, lessening the restrictions, that will pick up. Even the leisure travel kind of picked up in markets like Florida this past spring. But until business, group, and international travel pick up, I don't think that I don't think we get to anywhere near pre-COVID numbers.
Youngbin, you want to add something from the Herscher perspective?
Yeah, I echo Biron's sentiments pretty much. I mean, like, especially in terms of like luxury, if you're a luxury but you're still in a drive-to market, you're doing just fine. We have a hotel where we're actually in the summer in the Keys is beating what it did in 2019 in the summer. So I think there's just all that pent-up demand. But once again, it comes to the corporate traveler. We know that a lot of offices are reopening. I see people trickling into our office here as well. And I know this has always been mentioned too, the fact that with so many people working from home or a lot of people having relocated outside of where they used to live, we're now also seeing more hotel demand, even from our own company, for people who need to come in for a project and stay at a hotel. So I don't know if that would completely, once everything stabilizes, that will completely wash it out exactly, but that is some compensatory factor. And then a lot of it's really sort of just international visitation. I mean, that's sort of the wild card. I forgot, but I mean, Chinese visitation to Manhattan, New York City, of the overall demand was still like a pretty large percent. I mean, Dan, you probably know exactly like what that number might be, but I mean, until that comes back, you're sitting with a hole pretty much.
No question about it. It's all right. Let's move on here. The Save Hotel Jobs Act. Mitch, I know you'd like to go first. Why don't you tell us a little bit about what that is? Is it going to pass? What are the implications, sort of either way?
So I'm not, truly versed on the specifics of the act. I just know that, what I've heard from my owners and general managers, that, it's a real issue in the industry to get resources. I know a lot of folks have been putting out opportunities for jobs, and they're getting 20, 30 resumes, and then when it comes down to interviews, maybe one or two show up, and then of the one or two that show up, it's often that they don't accept the position. So I know my owners and my general managers are really struggling right now to get resources to get them to come back and support our guests. So I know this is a real challenge. And especially as the demand comes back that we've all been kind of talking about and hearing about, there needs to be someone to service these guests. And I assume, if this is an issue with my hotels in the limited service industry, I can only imagine the impact in the full service industry. From a brand perspective, I know that, we've laxed certain standards during the pandemic, but, from talking to our brand leaders and our operational leaders, those consumers are starting to demand that those services come back. And without resources to support that, it's going to be a real challenge.
The investment climate moving forward, I mean, we're seeing that transaction activity is actually picking up quite nicely when you look quarter over quarter, right? Q2 of 2020 was just devastating in terms of the lack of transaction activity. It's interesting. You gentlemen were talking earlier about, extended stay doing really well. Well, look at two of the smartest money sources out there, Starwood and Blackstone, trying to take down ESA. I think that speaks volumes. But why don't we talk about the investment market going forward? Biren, you want to start with that?
Yeah. So as you mentioned, the buyer activity has picked up very quickly, right? I think the problem now is that there's not enough inventory to fill the demand that's been created, right? There's a big shift in how asking prices are determined. And, with the rise of construction costs and inflation of almost 20, 30%, asking prices have even gone up 10 to 15%, even though the revenues might not have picked up to pre-COVID levels. And I think that hotels are trading more on a per key basis as replacement costs continue to go up. I think the good news is banks are starting to open up hotel financing, and maybe an asset that was maybe priced at 10 million is now 12 million because most of the sellers are raising their prices. And there were a lot of buyers that were sitting on cash during the pandemic thinking that the foreclosure market would come through, and come through at the 30 to 50 cents on the dollar. But that wave of foreclosures never hit. So there's a lot of capital out there. So I think that's why there's a demand right now in the investment climate.
Great. Young Bin, you want to weigh in on this?
Sure. I think, as with everything else with the market recovery, it's really case by case basis. You see a lot of activity around sort of the more, I won't say trophy, but a certain level type of asset. And obviously, drive to leisure is going to get the most attention right now. But even with lenders, there's some lenders who do not want to take a chance on an unbranded hotel. And then, especially on the limited service side, unless you can aggregate enough limited service hotels for a portfolio, you're not getting as much of the one-off transactions as much from what I've seen. So it really depends on also just the market recovery. So yes, there is a lot of capital chasing deals, but they're sort of focusing on very select deals where it's getting a lot of activity and getting bid up. But as a whole, I don't think that across the industry, I don't think that it's really just there yet.
It's interesting, your comment about the upper end. So this morning it was announced that Ventana in Northern California is trading, Big Sur, is trading for $2.5 million per key. A couple of weeks ago, Sunstone announced the acquisition of the Montage in the Napa area, also over $2 million a key. And there's been $2 million per room trades thus far this year as well. The Four Seasons in Orlando at almost $1.4 million, and then the Mountain Chalet in Aspen over $1 million a key. So it is interesting. To your point, there's so much money out there chasing yield, both not just equity but debt as well. And ultimately, we've seen and we're going to continue to see some distressed related transactions. But because of all the money out there, pricing is going to get bid up, and the ultimate transaction prices are not necessarily going to reflect distressed pricing.
Right, and it all depends on the asset as well.
Yeah. Mitchell, you're the development guy and the optimist. Talk to us about the development pipeline. How is that looking at this point?
Absolutely. So, my business, like yours, Dan, I think going into Q1 of 2020, I probably had the strongest pipeline I had seen, especially even in major metro markets like New York City and Long Island, including the 5 boroughs in New York City. I think I had probably 3 to 4 times the normal deal pipeline going into that quarter. And then as yours, it fell apart. A lot of that disappeared. And then, kind of went dormant into Q3 and Q2 and Q3. But it's been interesting. For me, it's really been the last 30 to 45 days where I've seen this significant uptick again, where it's really started coming back. And I do attribute that, similar to my answer to the first question, is it kind of followed the sun. I cover from Delaware up to Maine are my primary states for development and support the owners within those territories. And I really saw the development come back as that sun kind of came up the pike. And it came back into the cities and in the municipalities that were supportive of development. There's some municipalities and states which, were slower to open, and those hotels were still significantly impacted. And that's impacted my development pipeline. But what I've seen mostly, even in brands that, typically that I didn't sell, maybe because of a potential rate cap, ones like Candlewood Suites, which is our extended stay brand with no F&B. Those are ones now that have a huge demand because of the extended stay, because of the low service cost model. I'm seeing that as a development option, significantly within my territory where I haven't seen that before. So I think, there is a lot of money out there, and the smart money is looking for these markets that, have been resilient, the drive-in markets. And they're looking for these low service cost model operational opportunities. And, the pipeline for me, at least the conversations are strong. The hardest part is going to come down to financing.
Biren, why don't you talk to us a little bit about operational changes that have occurred during the pandemic? are any of them going to endure post-pandemic? Good or bad operational changes in terms of bottom line profits, I should say, and maybe also sort of weigh in a little bit on sanitation and cleanliness. Right, that was a big thing when COVID first hit. The AHLA and I believe AHOA, was involved as well in terms of, coming up with a program to make the traveling public feel safe and secure to stay in hotels.
Yeah, I mean, the sanitation standards, I think, are still going to remain, right? We have to continue to boost the consumer confidence where they feel safe to travel and staying in hotels again, right? So I think that whatever the brands and hotels created during the pandemic is still here to stay.
What about daily cleaning? Is daily cleaning coming back?
My personal opinion is that it should be opt-in, opt-out, right? And I think that as some of our profit margins are shrinking by the day, that we might need to even start charging for housekeeping. Even with breakfast, right? During the pandemic, a lot of brands had kind of, went to reduced, like a grab and go type thing. But I feel like hoteliers think that as we're coming out of the pandemic, that we're going to go back to the brand standards that we had pre-pandemic, and we're not ready for that yet. Maybe the consumer is, but as hoteliers, we're not, right? I think that there needs to be a modified version for breakfast for the foreseeable future until we get back to pre-COVID, and then kind of reevaluate, was the elaborate, extensive breakfast necessary for the guest? I think that we need to kind of condense it. This is a time that we can make a change for the industry and kind of give the stuff that we need to the guests to make their stay enjoyable, but not as extensive as it was. I think that even when you talk about operational, changes, I think there's more cross training happening because of the labor shortage, right? And so we're having to cross train our employees, fill in different departments, just so we can keep the hotel afloat while the demand is picking up or occupancy is picking up. And then mobile entry and check-in kiosk. We're gonna have to start looking into technology to kind of where we can cut costs to help our bottom lines out.
Great, Youngbin, you're on the management side. Talk to us a little bit about the relationship between managers and owners. Has that changed during the pandemic, and what will that relationship change as we continue to come out of this situation?
Sure. I think especially during a pandemic, with the owners, there's been more frequent, more open communication, especially since a lot of decisions just need to be made quickly. We also need a lot of owner approval versus, obviously in a typical environment, you can sort of lay out the budget, you're within the parameter, but with things changing so quickly, and especially with government regulations and any type of reopening, that has to be. So I think the transparency as well as the communication has definitely increased and improved during the latest. I would say going forward too, it's going to be a lot of touch and go still, I think, for the next year or so, where that will continue as well, where things are not going to be stabilized anytime in the near future. So there will still, you're not going to just have like your monthly call. You're still going to have to do a lot of the updates and communications in between the monthly calls, and that's what we've been doing.
Great. Yeah. I think we're going till 11:20. Is that correct? I believe so. So I think we're just wrapping up here. Why don't we go around the horn? And from a business perspective, I mean, we all talked about how we're optimists, right? So from a business perspective, there's always a silver lining in if you look hard enough in sort of negative situations. What is the silver lining for the hotel industry that you see because of this recent crisis?
Do you want me to start? I'll take a start,
and
I'll say, look, I'll go real quickly. So, look, I think and hope we're past the worst.
By the way, you don't have to go that quickly. I just got the heads up that we actually have till 11:33. So, Keep talking.
Excellent. I don't want to steal everybody's time, because I'd like to hear my voice, which I don't. But so look, I think and hope that we're through the worst of it, right? And I'm hoping for that there's not another outbreak and we don't see closures like we've seen. So if we're through the worst of it, the way I look at the silver lining here is that there is a lot of pent up demand, and I think there's a lot of great properties out there that are doing the right things, and our partners and our owners have been diligent through this process and hopefully done what they did to be able to survive and are ready to come out, support our guests, support our brands, and support the industry. So, the silver lining in any of these pandemics and any of these issues is hopefully it brings us, closer together as a group of people. And the opportunity when we're coming out of this is to be able to service our owners, our guests, with the pent up demand that I believe is out there. So hopefully I'm looking for a strong uptick in occupancy and in ADR.
Yungbin, what do you see as the silver lining out there?
So I would say initially with the onset of the pandemic, a lot of people feared that the investor class would not return to hotels because of just how devastating COVID has been to the sector. But then now you're starting to see that there is the investment community sector really diving into hotels because they can't find the yields in the other asset classes. So I think this, from investment, the silver lining, more people are now chasing hotels for the yields than we would have imagined. And also another interesting thing is you're starting to see a real divergence in the different investment groups of how they view the recovery. So the value add was getting pretty tough in 18 and 19, but now you're starting to see which groups are more bullish than the other groups on the sector. And there's starting to be a real separation that you can identify versus everybody sort of just being like at the same, viewing the investment exactly the same way. And it just becomes a bidding war. Yeah.
Terrific. Baron, the silver lining.
Daniel, well, before I get to the silver lining, I want to talk about a little bit, some of the lessons that we've kind of learned during this crisis, right? I think that not to over leverage ourselves or overspend on assets, even though that's happening, keeping the liquidity at hand, and then having strong relationships with the lender and brand, taking care of your employees. We all know that inflation is here. Government rescue somewhat kept us afloat, and now we as taxpayers are going to have to pay for it. Having said that, I think the silver lining is, I think just like what the promo video said before our segment started, is that we're resilient, right? Our industry is resilient. We've had to go through 9/11. We've had to go through the 2008 recession, economic crisis, and now we've gone through a health crisis, right? That nobody anticipated. But one thing that I will say is that we usually come out of this on the better end, and I think that we'll still do that as we come out now. I think that we're, resilient is the key word, and that we'll get out of this sooner than later.
Great. Interesting. You mentioned inflation. Yes, that's become a big topic these days. And I believe that that's also the reason why we're seeing even further investor interest in hotels, right? Because of the fundamental premise of leasing guest rooms every day, and with technology being what it is, being able to change room rates by the nanosecond, right? And we all know that, in an up market or inflationary market, it could be a beautiful thing, right? Assuming your expenses aren't going up equal to or faster than inflation. But in a down market, that repricing activity will kill you, just like we've recently experienced. So, listen, there are lots of prognosticators out there, and towards the beginning of the pandemic, folks were saying, it's going to take, 2025, 26, 27 to recover. Right now, because of the rapid increase in demand, faster than expected, quote unquote, people are pulling back on their projections of when we get to 2019. Right. At the end of the day, let's face it, we all really don't know. Right. But with that being said, you guys are in this space day in and day out and sophisticated and understand the sector. And let's face it, you play with money in terms of investment. What do you see as sort of the year that we get back to 2019 levels? I mean, I've heard some people say it's coming as late as 2022, beginning of 2023, and then other folks are still further out there. So, Biren, why don't you start with that one?
Well, as you mentioned, everyone has their opinions on this. I think that occupancy is going to continue to rise. I think that, there might be some markets where the ADR is good, but overall, as an industry, I think we're at probably 2005 ADR, and that's, I think, what's going to take the longest to bounce back. So I think that as soon as corporate travel starts to stabilize, we'll get a better idea of when everything comes back to pre-COVID numbers. Like I said earlier, that I'm hoping that corporate travel starts back at least in the fall. So then the projections of 23, 2024 are not, correct, and we kind of start going back to pre-COVID stuff during 2022. But I think that ADR is going to be the hardest thing to take the longest to come back. I think occupancy is coming back for most of the markets. It's all going to depend on corporate travel.
I think we'd be remiss if we didn't, all of us, acknowledge that very recently our friends Lee and Teague Hunter produced a terrific event in Atlanta with 1,200 people, which is quite remarkable. I think I also heard in passing earlier today, or maybe yesterday, that Las Vegas is hosting its first major mega conference. I don't know if any of you have heard about that. Maybe not. Okay, maybe I just dreamt it. Mitchell, why don't you talk about when are we getting back to 2019? I mean, you're the optimist. Maybe you'll even say we're there now.
No, I'm not going to say we're there now. I'd say, look, we've definitely made some progress, and we're not where we want to be, which would be back to 2019 numbers. But I never admitted to the 2024 number. I was always a little bit inside of 2023, and I agree. I agree with Biren with what he was saying. Occupancy. I see occupancy obviously coming back first, and we're seeing that. Like I said, real strong Memorial Day, definitely in these drive-in markets and these leisure markets, which is great. And I hope that the ADR, will soon follow. I was reading, I think it was a CBRE article, which said, occupancy coming back and the ADR might come back in 2024 was kind of their most recent target that I think I saw. But with these positive announcements, like the one I mentioned about the CDC opening up international markets, universities coming back online starting in the fall, all these things I think will attribute to that number being brought in closer. But yeah, the big gamble at the end of the day is when do corporates come back and how do they come back? Will it be something different than what we were used to, or will these, with the face-to-face meetings that I so much rely on, be critical and people will get back on the road.
Terrific.
Daniel, if I may?
Sure, please go right ahead.
I know you were talking about the Hunter conference with Teague and them. I'll tell you this, that there's that pent-up demand, and, it's going to be interesting to see how Alice plays out next month in California. But even in August, our conference is coming up, and we've already have 4,000 attendees already registered. And that's without our vendor partner. So we're expecting over 5,000 in August, as long as there's no hiccups from now till then. So, people are ready to get out. People are ready to network. And I think the rest of the year is lining up to be a good one.
Yeah, the owners that I've spoken to are thrilled and excited about your conference. It now being located in a central part of the U.S. During a great month for travel. I think that is going to be the conference to get to.
Was that a little?
I do have I do have one thing I just want to note about corporate travel. As I agree that that's sort of like the last thing that we really need, but also just the human element of probably need like 2 cycles of RFP process. And going into next year, I don't think the sales management teams are going to be as aggressive as because of everything they've been through for the last 2 years, where probably this RFP process, I think they just need to get it under the belt. And then next year, once the demand is back, then they can really start pushing the rate. And so I think it probably needs like another cycle, like 2 cycles of RFPs to sort of get it close to where we were.
Okay, we have 3 minutes. Here now is finally the last question, right? Your own money, right? Where are you betting your own money on a single asset deal? Mitchell, where and what?
For me right now, I think I would have it in something like a Candlewood Suites, an extended stay property with low services, no F&B, and that will keep my costs low. In a drive-in market, something like a Lake Placid, something that's going to have strong demand near major metro market with drive-in capability. And, I'd hope that I could open it up tomorrow before the summer.
New build or acquisition, repositioning?
Well, the challenge would be is that I couldn't open up a new build tomorrow. If I had one, I think, a great marketing aspect, I believe from a hospitality perspective, we touched on it. Clean and new would be wonderful. So, I would expect a good solid renovation. New build and that cleanliness, I think, has some cachet to it. If I could get a new build that would open up tomorrow, I would do that.
Youngbin.
I would definitely go towards something like in a mid-scale pricing resort in Florida, where I feel like that's, that covers the biggest segment of demand for the general American public. And I also feel like at that pricing level, a lot of your customers aren't going to be as afraid of COVID as sort of more white collar, can work from home type working class. So I would definitely go towards that because I feel like it'll just pick up immediately. There won't be any drop off from 2019 for those types of assets.
Great. And Biren, going to let you clean it all up here.
I would look into under the radar markets, acquisition that I can reposition at this point in time. With building costs going up, material costs going back up again, I think there's opportunity where we can acquire some properties at a decent price point and reposition them. Right now, there's also brands giving incentives to convert over to their brands and even some key money. So I think there's some good incentives out there that we can take advantage of.
Terrific. Well, I think our time is up, and I want to thank you, gentlemen. I know that we're not live and can't clap, but I'll clap for you. Mm-hmm. And I'm not sure who I hand this back to, but thank you very much for attending and participating, and really enjoyed collaborating with you, gentlemen. Thank you.
Thank you. Thank you as well. Thank you for your time and questions.
Our third panel of Hotel Optimization Part 4 is Tips for Leaner Operation, which is moderated by David Eisen, Director of Hotel Intelligence and Customer Solutions at Hotstats, and sponsored by Bounty. Please add your questions for the panelists to the Q&A tab on the left side of your screen, as well as look at the Handouts tab. Here are a few words from our sponsor.
Hi, I'm Steve Sinclair, the founder of Bounty. I transformed an inefficient lost and found into a high-tech, low-touch solution. With artificial intelligence and geolocation technology, say goodbye to the hassles of data entry. Using Bounty is as easy as taking a selfie.
All right. Well. Thank you. That was a great lead, and I know I've left many ties in hotel rooms before, so I could have used Bounty many times before to probably get those back. But thank you, and thank you, QuestX, for having us today. We are focused on tips for running a leaner hotel operation, which obviously encompasses how to contain expenses. And this is a topic I think that's never been more vital than it is right now, coming out of the pandemic where we are right now. Obviously, making sure revenue flows to the bottom line and kind of what the tips that hoteliers are doing to make sure that they're seeing this kind of flow through. So obviously, this means containing costs, whether that's in labor, as everyone is kind of talking about right now, operating supplies, F&B, et cetera. We're going to jump into all that great stuff today on this panel. So what I'm going to do is give a brief, quick introduction to all of our panelists today, all three of them, and then we'll jump into questions. So in the upper right-hand corner, as I think you see it, that is Javier Cole. He is the group president of Apple Leisure Travel Group, whose 8 all-inclusive brands include Zoetry, Secrets, and Dreams. And right below him, actually diagonal to him, would be Justin Jabara. He is president of Meyer Jabara Hotels, which operates more than 25 hotels in the U.S. across myriad hotel brand families, including Hilton, Marriott, IHG, Choice, and Hyatt. And then last but certainly not least, we have Tracy Ripa, who is senior vice president, North America franchise operations for Wyndham Hotels and Resorts. As I'm sure many of you know, the Parsippany, New Jersey-based franchisor has 21 brands across multiple segments. And congratulations, they just launched a new soft luxury brand called the Registry Collection. So congratulations on that. All right, so let's jump in, folks. We're talking about how to run a lean, mean hotel operation. Running a lean operation is obviously easier said than done. It comprises many variables. But in the context of where we find ourselves now, still in the midst of a pandemic, obviously better off than we were just 6 months ago, running a lean operation takes on even more gravity and more importance. So the first question then I'll pose to the panel is, what does running a lean hotel operation represent pre-pandemic to what it means now in a post-pandemic world? And I'm going to throw it to Tracy to start off. Please take it. I think you're on mute, though.
Can you hear me now?
Yes, there you go.
We've only been doing this technology stuff for a little while now, right?
Yes,
so thanks for having me. I appreciate it. A leaner operation now just means that all hands are on deck, right? GMs and owners are rolling up their sleeves. They're getting in there. They're checking in guests. They're cleaning guest rooms. The focus has to be on cleanliness and providing a safe and secure hotel for the consumers to feel that they can trust to come back to the industry and back to the hotels, right? What happens then is capital investments that might have to be deferred, right? I mean, right now renovations are not in scope. Labor shortages, as you mentioned, and others have mentioned today, are also happening in the supply chain, right? And so that's making it harder for us to do small renovations and things like that. So pausing those renovations and amenity upgrades and making the hotels focus on the cleanliness piece, those GM and owners are actually rolling up their sleeves and they're getting in there. And that is one way that it's changing, and we're able to work leaner. The other way is really subcontracting. I mean, you hear from a lot of franchisees of ours that say, I have to be checking in guests and checking out guests, and I can't make those sales calls, right? And so without having to hire an added person at the front desk or to do that, what they're doing is they're reaching out to companies like Jack Caruso and some others that allow them to almost like a paid per performance model, right? So they're not paying a full salary for a salesperson or things like that. Revenue management services, they really need to people need to lean on the brands, right? So brands have services that they can lean on and instead of having to manage their rates and inventory themselves, they can lean on our Wyndham properties can lean on us to help manage that for them so that they have more time and less people that have to service the guest, right? So again, redeploying the energy and time to things that that are needed right now to have a clean and safe hotel, and letting some other venues do some of the other work for you.
Thank you. Well, from that well-made bed behind you, I think you probably jumped in and made a couple of beds in hotels before too. So
don't laugh. I was on the road last week, and a franchisee asked me. I said, "What can I do for you?" And she said, "Can you strip beds?" And I said,
Nice.
"Absolutely, not a problem."
Very good. Thank you. I'll throw it to Justin. How about you? Pre-pandemic versus now. I mean, what does running a lean hotel operation mean to you, and how are you getting it done with your hotels?
So pre-pandemic, we noticed a trend of margin erosion that was taking place, and during the pandemic, we were faced with revenues that either fell off 40% to 100%. I mean, we had properties that were closed, and that forced us to reimagine our operations. And we broke it up into two buckets. It was the on-property operations and then the corporate and support structure operations. So coming out of the pandemic, we need to take those lessons and continue to apply them, and look at how we maintain margin as we recover. We're not out of the woods yet, and there's a lot of ground that was lost financially over the last year and a half that we need to make up for now.
Yeah. And Javier, I'd love to hear from you. You know, obviously, Apple Leisure Group, you're running these larger kind of, all-inclusive resort properties. A lot of things going on, right? From the guest experience to the services that you dole out on property. So what has it been like then during all this, from before, where everything was great pre-pandemic, and then April last year hits and everything just kind of falls off the face of the earth? Obviously, what we've heard from the prior panels is that the resorts actually have been a little bit more resilient than some of the other kind of city center full service properties. So what has it been like for you, and what are you kind of doing right now to kind of run that leaner operation?
Well, I guess for us, it's a little bit more challenging from the point of view of our hotels are all inclusive. So what happened is the customers, they expect an all-inclusive experience. So there's a lot of things we cannot do. I mean, if you're selling a product that has 8-9 restaurants, so you can try different experience, different food and beverage experience during your stay, you cannot suddenly shut down 4 of them just to cut costs. So that's we need to keep them, or at least most of them, open. So we deliver the value promise and the product promise that we sold. So based on that, our approach was focused on our team. So basically, what we did is we invested in several ways in our core teams in every hotel. And basically what that means, and also regionally, what that means is we wanted to have a constant communication with them, a 360 feedback with them to reevaluate every process. So that was our approach. Let's reevaluate every process, because at the end of the day, we've been in business for 20 years as a hotel chain, so we're pretty young. But even after 20 years, we recognized that we were not as efficient as we could. And by reevaluating every single process, every single customer interaction that we have, we were able to change some of those processes to be more efficient. And by doing that, cutting costs in terms of needing less people, for example. So that was one of the things that was very important for us. We also added some technology to make sure that we were also very efficient in terms of how we use the technology and how our people had the right tools to be as efficient as we could. So that was more our approach. Instead of trying to cut the product, what the customer sees, we try to get better processes and better time management and all those things that the customer don't really see. just to make our operations more efficient. So that was our main approach, to be more lean in terms of our operations.
Yeah. So obviously, I know that goes into for all of you. I'm sure it's you try to run a lean operation, but you don't want to infringe or impact the guest experience. I think that's probably the biggest thing. Although it can be difficult when we're talking about labor, but we'll get into that in a couple of questions subsequently. So I wanted to throw the next question to Justin. One of the things when we talk about running a lean operation, there is that kind of idea of cutting some fat or trimming some fat, as it is. Is it fair to say when times are good and revenue is flowing, expenses maybe aren't looked at as closely as maybe they should be because everything is hunky-dory, right? Meaning, is there constant appraisal of expense? So has the pandemic altered that, or is it now are you really inspecting every line item and looking at things like zero-based budgeting moving forward? I mean, how closely are you post-pandemic? You have to really dig into the P&L and say, okay, we need to really look at each one of these costs and figure out if it's something we need to keep or something we can do without.
Right. That's a great question. And, we've always, every year we zero-based budget, whether it's the property or at the corporate level. So those functions were taking place, but what the pandemic forced us to do was, similar to Javier, is really analyze our process, but B, also at the corporate level, what are the services that we're producing out to the field, and what is the value of those services? And to the extent that there was not enough value in that service, it was either changed or taken away. From a process standpoint, we relied very heavily on technology. So over the last year and a half, we've been doing significant technology upgrades to our organization at the property level and at the corporate level. An example of that is one wing of our office was sales and marketing teams and revenue management and regional sales and digital marketing, everything else. The technology has gotten there with revenue management platforms, depending on the brand and the asset, but the technology is there where they can run autonomous or semi-autonomous, which thus makes the revenue management process so much more efficient. So we dug heavy into those couple areas. The other thing that we did was we reached out to all of our vendors, and we just had an honest conversation with all of our vendors as to where we were and what the future looked like moving forward.
Gotcha. Interesting. Are you saying that the job of revenue manager might become redundant in the future? Should we not go to school to be revenue managers? Something else, maybe?
No, I wouldn't say that. What I would say is, at least in our organization, the role of a revenue manager looks much different now than it did even last year.
Gotcha. Okay. Way to diplomatically put. Well put. Tracy, how about you? From the brand, what's the brand perspective on this in terms of looking at costs? Obviously, you're the brand, you're representing. Your name is on that hotelier's front door. What are you doing to help a leaner operation? What are some of the tools that you might be equipping with them or training them on?
Yeah, so similar to what was said already. We really looked at our vendors and talked about how we can go back out to the vendors to bring the most cost-effective OS&E supplies to our hotels. How can we make sure that that services and FF&E products and things that they needed were at the best price that we could get for them, right? Using the size and the power of Wyndham behind us to negotiate those price points for them, right? We dove into the breakfast like everybody else, and we peeled back the standards on breakfast and reevaluated that so that our franchisees could choose a minimum breakfast to a higher end breakfast based on the needs of their customers, right? Being flexible with our franchisees to allow for the consumers to get what they needed in those hotels based on the needs in that market, right? So doing that and reducing and allowing flexibility in our breakfast for our owners helped a lot. I think, listening to the customers, if we all could just listen to the customers a little bit more, they will tell you if they want housekeeping or not, right? So some of them don't want us in their room, right? When they check in, that's it. They check in, they don't want you back in there until time check out. So we have some guidelines around that because we have to be careful there too. But the reality is, listening to our customers allowed us to reduce some of the costs that we had, because we're automatically doing things that they might not have needed, right? That when I check in, corporate staff member, I don't necessarily need service, right? So I think doing those and allowing for flexibility in our standards allowed for the reduction in some of the cost, going to our vendors and pushing our vendors and using the buying power of Wyndham to get down those costs. Those are all things that we did to help reduce for our franchisees.
Yeah, and Javier, obviously it's a little bit more difficult, I would think, at an all-inclusive resort to kind of, from a maybe a housekeeping perspective. I'm not sure, because obviously, guests are coming there. I would assume it's majority are leisure travelers, families. They're looking for that, that impeccable service, and that I think includes those types of amenities and services. Are there other things that you were able to maybe, I won't say cut, because that's kind of a harsh word, but kind of to trim or kind of move around such that you were able to kind of run that kind of more bare bone, leaner operation, even though it being kind of difficult when you are running these, luxury resorts in some respects. So what were some of the things you were maybe able to kind of pull out?
It goes back to my previous comment. So by reanalyzing everything we do, we focus on, we try to focus on what the customer values, right? Basically is the product. What things of the product the customer values and is willing to pay. And the way we thought it was, okay, everything else is basically waste, right? Think about it like time movement, for example. When you analyze waiters and maids, how they moving around the hotel, is it really the time efficient in terms of what they do? So that's one of the most important things we did, and we realized that we were not not perfect in terms of how we assign the shifts, how we assign the buildings to those employees, because what happens is that when you have laborers in some places, you're very limited in terms of when you have, unions in some places, you're very limited in terms of what you can do. But in our case, in our countries, you don't have the restrictions. So we were using our labor in a multifunctional way, but not necessarily in a very efficient way. So we had a waiter working in a restaurant, but based on the occupancy of another restaurant, we were moving that person to the other restaurant. Now, that could be efficient if those restaurants are close by. They're not close by. There's a lot of time that you're wasting. So what we did is we reanalyzed that whole process to make sure that the time movement was very efficient. Same thing with maids. That was one thing we did on the operation, and we were able to save like 15% of the labor just by reanalyzing that, which that was very positive. But then we did things on the marketing side, for example, again, things that the customer not necessarily value. Basically they're concentrating in the product, right? What I'm getting when I go to your hotel. But they're not concentrated in, for example, how many brands do you have? So what we did is that we concentrated brands. And by doing that, we were more efficient in terms of the marketing expenses. We realized that we had a lot of brands for the number of hotels we had. And the reason was because of the growth, right? Trying to avoid radius restrictions, all that led us to create additional brands, not to compete with the other ones. But the reality is that by creating brand extensions instead of creating new brands, we were able to avoid issues with other hotel owners. And at the same time, we were able to concentrate marketing funds in fewer brands. So we were able also to save a lot of money by doing that. And lastly, on the corporate side, not on the hotel side, but on the corporate side, we basically, by using technology, we reduce our square feet by 2/3. So we are 1/3 away we used to be in terms of a square foot, just by using technology. Of course, now Zoom, Teams, all that. But also we implemented this app that our people now, they don't have fixed desks in our offices. They just book one of them, and they show up maybe 2-3 days a week. So all those things combined, it really help us in terms of our cost efficiency.
Gotcha. I like the time management thing. I think a solution would be to get all your employees scooters so they can ride to their next position whenever they had to make a switch, get there quicker. I wanted to address kind of the 800-pound gorilla in the room. That's obviously labor, because that's all we hear about, whether it's in hotels, restaurants, what have you, and the difficulty of filling roles. Obviously, it's your biggest cost. According to our data, Hotstats data, labor on a per available room basis in April of 2021, it's up now 51% year over year. So obviously, everything was down from an expense standpoint, but those are creeping back up. Obviously, the pandemic and the impact, it's reshaped the labor challenge. And at the outset of the pandemic, obviously, it was slashed through whether it was layoffs or furloughs, things of that sort. But now as demand rebounds, it's proving difficult to fill positions due to a variety of reasons covered, within the national media, whether it's unemployment benefits or other even workers migrating to just other industries and have left hospitality altogether for other industries. So how is the labor predicament currently impacting your businesses? And what do you see kind of the outcome the outcome being? And do you think like labor is going to be something that's more dynamic, on-demand labor, or are we going to continue with just the normal kind of FTEs? What's the shakeout here? Tracy, why don't we start with you on that matter?
Our small business owners, our franchisees are feeling these effects, right? We are definitely looking for ways to try to help them. We're looking to partner with employment agencies and search engines to drive talent to their hotels. The hotel owners are providing, cross training for their staffs, right? So whereas before, a housekeeper in the pre-pandemic market might not have moved to a front desk job or something like that. Now they're opening up opportunities for people to move within jobs within the hotel from a cross-training perspective. The other thing is the managers and owners are getting a newfound respect and appreciation for that line level work that's being done. And then I think the biggest thing is, if we can stay as an advocate for our franchisees and for the industry, continue to push, the local and federal governments to help in these areas, I think it's really important. So we continue to advocate for the franchise community and for the industry. But I think labor is going to be coming back based on that. And I think we have to remember to try to hire for that personality and good attitude as we are in the service business. And I think that, again, franchisees are going to have to, we're going to have to help them as a brand, try to help them with tools and resources to find that staff.
Yeah. Justin, for you, is it getting, we all hear about how labor, it's becoming more expensive. Is that what it's been like for you, and how are you kind of addressing that? Obviously, it's a good thing that occupancy is growing up, demand is coming back, absolutely on the leisure side. I'm sure you guys are gearing up for the summer. So what are you doing in that regard? Is it worrisome? What are some of the things that you've taken to help it out?
All right. Well, my mind for the last year and a half has been thinking about revenues, and now we're thinking about labor as an issue. So, which is a good thing. What's been interesting to us, and I heard a statistic the other day that the Cape had only 40 to 50% of the seasonal workforce that they needed to make it through this season. So we, Marge Bar, have always prided ourselves on being a industry leading organization to work for, but what we've learned is to be industry leading is not good enough, because we're competing against Amazon and all other industries within our markets who have actually had a pretty good year. our industry was impacted heavily, but many industries are having record years, and so what we found is, as an employer, we've had to get more creative with our benefits and what we provide. For example, digital tipping for housekeeping, right? So that's more dollars to a housekeeper's pocket. E-wallets, right, for paychecks, so real time payment, day by day, things of that nature. And at the end of the day, the reality is labor is more expensive, and so we also need to be more efficient with it. And so we have a whole task force that works on this.
So we're at a point now where we can tip housekeeping via Venmo.
We're working on it. Yep. And that's something that we hope
I love it.
By
the way, guys, I'm sorry. Yeah.
It's a great idea. It's a great idea.
There you go. See, we've already brokered something right on this during this panel. I apologize. I think I'm on a little bit of a delay. So I apologize. I apologize if my words are getting too slower than they should be. I am coming from Spain, so it's far away from you guys. All right, so I'll throw it to Javier, actually, because obviously running all-inclusive resorts from a labor perspective must be a harrowing task for you. How are you dealing with the labor crunch? Are you seeing it as well, just like Justin is, just like Tracy is, just like everyone was talking about? What does it look like in your space?
Well, we had in our destination good news and bad news. The bad news were that the governments were not doing much with the employees that lost their jobs during this period of time. The good news is they lost their jobs, and what I mean is it's been very difficult in the United States to, for example, go back to the levels of call center employees that we had, because they were making more money just by the unemployment incentives versus working for us. So it was really difficult, and we had to move to third-party suppliers to cover some of, a lot of that service. In other places like Mexico, Dominican Republic, people was eager to work. So we didn't really have an increase in terms of cost, and now we have even more options in terms of hiring those employees, because there's a lot of unemployment in those places. So the good thing for us was, in our hotels, never had an issue with that. So the moment we needed more employees, we were able to hire them, and even in some cases at a lower cost. Because of the need. Definitely not in the United States. I mean, a very, very big chunk of the people that work for us is on service in call centers, right? Different services related to call centers, and we really had an issue with that. So very different from country to country, and very different from the United States to other places where we are at. In Spain or in Europe. A similar thing. The government give a lot of help to unemployed employees, and we're still dealing with that. It may not be as bad as we had it in the United States, but still a similar issue, because some of them, they're just taking a long vacation. They just don't want to go back to work. So, but again, it's not that bad compared with the United States. In the United States, we really had an issue, and at the end of the day, we had to change the way we work, which is basically work with third parties, which more inconvenience in terms of training and all those things. That for us is very important. So.
Yeah. Justin, you want to take that call? Was it important? Let us know.
Yeah, we got a new phone system. I don't know how to silence it. So one of the things that we have seen is, as the states do away with some of the unemployment benefits, the extra stipend and things of that nature, the labor markets loosen up pretty quickly. I mean, to our surprise, within weeks, if not days, people that we were calling to say, hey, do you want to come back to work? All of a sudden they're calling us. So that is one of the nice things that we're starting to see as state by state they handle this issue.
Yeah, I know that they're starting to phase that out, I think in September. So that, I mean, maybe that's what I was going to ask. Tracy, are you seeing that as unemployment benefits and the federal kick in? Is that one of the biggest portions of that? Are there other things? I mean, I've read things like, employees or potential workers, it's cheaper to stay at home and watch their kids instead of paying for things like childcare. I mean, these are real issues that impact frontline workers. I mean, what is the brand looking for seeing? What are you seeing at Wyndham and
Yeah, I think it is the unemployment. As that runs out, we will start to see people come back, and right now, as when we were calling them to come back, they were asking for more money, right? They're like in some of our managed hotels, we were seeing that, and our franchisees were telling us like we just can't afford to bring them back at the rates that they're trying to demand from us, right? So I think it's the unemployment is impacting it. I think just the nature of the dynamic of the fact that everybody's their home lives have changed, right, is a huge impact, right? I mean, I have 2 children, and I know my life went upside down, right? I'm used to traveling 3-4 weeks out of the month, and then all of a sudden I had to figure out what to do with a 6-year-old and a 7-year-old. So I'm looking forward to September coming and kids going back to school and things like that. So I think if September is the time when everything will start to lift and open, then I think we will see a major change pretty quickly. To Justin's point, it's gonna change pretty quickly.
I wanted to ask about, we talked a little bit about, well, Justin brought up about technology and leveraging technology to keep expenses down. What is some of the technology you've adopted or leveraged? And I guess the real question is, are the upfront costs of adding new technology, are they worth the overall savings? I mean, I think I remember, years past, hotels have put in those kiosks used for check-in or check-out. They didn't really take, and I think a lot of them were moved out of the lobbies. I mean, what are the new technologies you think that really can make a difference and in the long run help keep hotel expenses down? I'll throw it back to Justin just because he brought it up earlier.
Yeah. So mobile check-in, I think, is one of the things that if you look at our industry, you just wonder why we haven't embraced this. And the pandemic forced us to really embrace it. And now we're looking at labor shortages and we're saying, well, I used to staff 3 people at the front desk. If I can push to mobile, I don't need to staff 3 people at the front desk anymore. So there's real return there. We did a full technology audit of our organization, and we just said, what's working, what's industry leading, and whatever's not's going out the door. Some of the systems out there are quite impressive. I had mentioned revenue management is one of the things that we've looked at, and some of the business intelligence systems that are there. But even, for example, just from our accounting department, the way we process AR, there's new systems out there that pretty much I had a whole team that was doing this, and now using AI technology, we're much more efficient. So one of the things I think the pandemic has forced us to do is really embrace it. There are significant upfront costs, and the implementations are quite laborious of some of these programs, but the end result in more cases than not is much better.
Yeah. What about you, Tracy, in terms of leveraging technology? Oh, I think I stepped. Leveraging technology. Go ahead.
We are exactly aligned with what Justin's saying. I mean, we were pushed, right? Everybody got a push and said, like, speed up your technology based on the needs. I think we would have gotten there eventually, but we definitely got there faster with the pandemic. That's one of the things that did positively come out of this. I mean, Wyndham, we launched our new mobile app, and it was the first in the industry to bring mobile check-in and check-out to 6,000 economy mid-scale hotels. I mean, to think an economy consumer, right, checking in, mobile check-in, check-out, it wasn't probably so far-fetched for a mid-scale or upper mid-scale or higher-end hotel guest, but for an economy check-in, check-out process to be mobile through this pandemic was key, and we did that, and we're really proud of that. We also, I mentioned before, just like knowing what our customers and asking our customers what we can do for them, right? And we launched our new customer data platform, enabling us to increase and personalize our interactions with our guests, which was really key. I mean, we needed to understand what our guests needed and when they needed it, right?
Javier, how about you? I'd love to hear from the resort perspective, the all-inclusive perspective. Is there technology you're able to put in place to streamline your operations? Whether it's it could be even like POS. I mean, if it's all-inclusive, obviously you don't have to pull out your credit card every time you're making a transaction at the bar, right? But what are some things you put in place from a technology standpoint that can help?
Well, absolutely. Technology was a key point for us during this period of time, and even before that, to the point that we bought a technology company. We acquired another tour operator on the travel side, and along with that came a technology company that we have used, that we've been using to basically standardize our platforms. And of course, lately we used it for trying to reduce the key touch points during the travel experience to make sure that we would be complying with a lot of the hygiene programs that we had to the COVID. However, we were already working pre-COVID. We were already working in terms of improving the operations. For example, we removed basically all the stationery in the rooms by using iPads or by using pad, right? So everything now is basically electronic. Anything you want to do in the resort, you can do it with your tablet. You can schedule spa treatments. You can make new bookings or order room service, and that besides the cost that we save by doing that, it really improved the perception of the service within the hotel. We also were able in our countries, you have to pay by channel when you have a selection of channels in the TV. So we're able to reduce those channels, saving money just by being able to connect to Netflix and all those services, streaming services. So at the end of the day, the net cost was lower than we used to have with a better service, right? So again, we reduced the number of concierge positions just by adding those tablets as well. So definitely technology is a key point for us, and we're just starting. I mean, we're not even close to all the ideas and the things that we want to implement in our resource related to technology.
Great. All right, we have 3 minutes left, so I'm going to ask this last question. I'm also going to add another one in there, kind of, because I want to get your take on it, so I can put the two together. So obviously, there are no benefits from the pandemic. Obviously, we've seen what it's done to the global stage. But if not a benefit, has it allowed or forced the hotel industry to think differently about the business of running hotels, and will it have a lasting effect? That's my question, but I also want to throw this in. They talked about in the last panel, they brought up things like daily housekeeping, other services. Are hotels going to become more like the airlines and start charging piecemeal for some of these items that were previously free? So if you could answer kind of both those questions together, that'll be our final question for the panel. Justin, you get to go first, my friend.
So I think, the no benefits from the pandemic, but it did force our industry to embrace technology, but also relook at our business model. We have full service hotels where midweek we give away 80% of the breakfast. Well, that's just not a good business model. So coming out of this, things you had mentioned, stay over housekeeping, things of that nature, and going back to what Javier said, we really need to understand the value of everything that we do, and if there's not value to there, or it's not profitable, it's got to go. So that and one of the biggest learnings that I personally took away from the pandemic is just the power of great team members and having great people behind the organization.
Great, thanks, Justin. Javier, to you.
No, I cannot agree more. I mean, you have to take into account that our teams and our employees are the ones that know the operation better than any of us. They know what's going on. They know what they can improve. So definitely by taking care of them, by helping them, by giving them the tools, it will go back to you in terms of savings, in terms of more efficient. So definitely that is, for us, that is a key point. We're not thinking in cutting in terms of the product. We're not thinking in giving less to the customers just to save some money. What we're thinking is making sure that the customers are willing to pay for the product that we provide. And if they're willing to pay $1,000 more because we offer more, then that's fine. But that is not in our DNA to start nickel and diming our customers, especially on the all-inclusive, right? Because the all-inclusive, you assume that is a hassle-free vacation, that you don't have to worry about anything, and you're going to get all the things that you're assuming are included in your package. And that's exactly right. So the moment you start, okay, you know what, now you have to pay for this, and you have to pay for that because this is extra, and this is your experience is not what you expect. And we are on the high end of the all-inclusive, so we cannot go to what the all-inclusive used to be 30 years ago. That is definitely not our goal.
Absolutely. Tracy, you get the last word.
Yeah, so absolutely not. I don't think we're in a position at this point, especially in the economy segment, to cut back any more amenities or resources. I do think that the pandemic taught us that we need to be flexible and nimble, and that diversifying our portfolios and our customers base is something that we need to keep our eye on as we run our day-to-day operations. I think that's that helped us at Wyndham, being diverse, helped us get through the pandemic. But I think we really need to focus. I agree 100% on what both gentlemen said. We have to be laser focused on treating our employees with the utmost respect and appreciation, because those are the employees that got us through the pandemic, and they then in turn treat our guests right the way that they need to be treated. So it takes more money to bring new people in and train them and get them up to speed than it does to treat the ones that you have with the utmost respect. And I think we really need to focus on our employees that we currently have.
Great. Well, thank you, panel. Apologies for some of the audio disruption. I will throw it back to QuestX. Thank you.
Thanks, panelists, for sharing your insights on this very timely topic. Next up is one more 5-minute break and then our final panel of the day. Our last topic of the day is putting your space to work. Led by moderator Elaine Simon, Senior Managing Editor of Hotel Management. Welcome, panelists.
Thanks, Amy. We're going to wrap up today with a discussion about how to make every square inch of your property work and bring in revenue. Joining me is Jen Chauvin, Vice President of Catering and Event Management for Ambridge Hospitality, who has over 25 years of experience in event management, in addition to 2 degrees focused on public relations and marketing. Next is Ron Lohman, Senior Vice President at Real Hospitality Group. Ron, who also has more than 25 years in the hospitality industry, has direct hands-on involvement optimizing the value of assets within the company's portfolio. Last is Raul Maranta, Chief Commercial Officer at Remington Hotels, who in an unplanned twist also has more than 25 years of experience and has direct oversight of sales, revenue management, and digital marketing for all of Remington's hotels. Thanks for joining me today. I'm excited to talk about this topic with all of you.
Thank you.
And just a reminder for attendees, if you have any questions for our panelists, put them in the Q&A tab on the left side of your screen, and we'll get to those as many as we can. So everything the industry has experienced in the past year plus has forced the industry to adjust more than has been required possibly ever, and then adjust again and again over again. I think kind of the silver lining to all of this is the amount of creativity that we've seen from hotels in terms of operations and keeping money flowing to the bottom line. And that's what we're going to cover today, how these 3 companies have used their space wisely to do that and how they will continue going forward through the recovery and whatever comes next. So let's start with you, Jen, and talk about F&B for a minute. F&B has been hugely affected by all the changes that have been going on. How have you shifted to make sure restaurants and other F&B outlets haven't been completely wasted space, and also to fit what guests still need, even with all of the changes?
Sure. Great question, Elaine. And before we get into the restaurant specifically, let's talk about our portfolio overall and the fact that at Ambridge, we operate about 1,500 hotels across 49 different states and 20 different countries. So when you talk about the lift of regulations and restrictions, it certainly is at a different pace in every geographical location. But the one consistency that remains is the fact that our guest has changed. When they come back into our properties, and as the trend showed today, we are welcoming them back at a great pace. But as they come back to our properties, they will have changed. They will have changed in the way in which they engage with each other, the space, and our service deliveries. And as we start off talking about food and beverage, F&B and the outlets is certainly one of the areas of our operations that you feel it the most. During the last 16 months, we pivoted in those operations. Many of them shuttered if there were multiple outlets on properties, but we also pivoted in the overall service delivery. So room service became knock and drop. We enhanced many of our marketplaces and saw the traveler using those marketplaces for up to 3 meals a day. And the revenue that was generated through those marketplaces certainly was focused significantly on some beverage opportunities and some healthy eating opportunities. It was an enhanced grab-and-go element in many of our hotels. And on your question around space, the reality is, as we've talked about, and I'm sure this panel will discuss as well, as we've heard throughout the day, the labor shortage and that challenge really forces us to do more with less. And it's us to be innovative. So in that space, we certainly have embraced more so and fast-tracked the integration of technology. So you'll see the QR, you'll see the online ordering, you'll see a lot of the different service capacities in kiosk and so forth that allow us to maximize that space when it's running as a restaurant. Now, from an event and meetings perspective, there's the opportunity to sell that stylized space for different areas of the business, such as broadcast studios in your PDR for reference, or in huddle areas, using that stylized restaurant space and converting it when that lunch might not be happening now in the restaurant. Your restaurant may have closed or shuttered for lunch, and we're sending attendees to that enhanced marketplace that we've built. So there's some opportunities there to do more with less, to leverage technology, and then to use that space and merchandise it very differently for meetings and events, for either intimate or larger spaces.
Mm-hmm. Now, since you do have properties in so many different countries, I know the rules changed and that makes a difference, but that new guest that you're talking about, are you seeing that they want the same things, or is that different even just by region or country or stage of where everyone's at?
It's truly different by region, and it's different by type of hotel. At Aimbridge, we operate 8 different verticals. So you have everything from the luxury down to the select and enhanced. So different consumers are coming and traveling for different reasons. We obviously have experienced more of a drive market in these last few months. And as indicated by the data this morning as part of this conference, fly is increasing. And with that become larger meetings and events, which we're happy to celebrate and welcome back into our space. But geographical restrictions certainly have played a focus and an element that enhances and impacts the way in which we deliver service and what the consumers are looking for.
Mm-hmm. Okay. Ron, what have you been dealing with in terms of F&B? How have you changed? What are you seeing that guests want? How are you making money out of this?
Yeah, we went through a couple-step process in order to get to it. And to Jen's point, it probably changed every morning when you came in and re-looked at it. But we really looked at what spaces could we repurpose throughout the hotels. That was a big one. And then we also looked at all those kind of target projects that we had in the food and beverage space. And maybe it was an opportunity to complete some of those. And in 2 or 3 instances, we were able to get the funding from the ownership groups to complete those. So those were 2 things. Obviously, outdoor spacing really helped us expand our capacity, especially towards the end of 20 and into 21. And then curbside was a huge for a lot of our independent hotels. We had one hotel that, just to give you some color, in the previous 3 years had done over 450 Thanksgiving Day meals. And we had cut that down to 1/3 just because of what it was. So we thought, hey, let's try curbside. We had never done it. We kind of set a target of 50 because we thought it was the right target. We ended up doing over 100 and had to come up with a plan of how we're going to stage all these pickups. Luckily for us, we had the parking space to do that because the seating capacity in the hotel. So really there again, being nimble and being flexible and really being creative. And some of the things were, taking best practices from some restaurants that we had seen, but really, engaging with the management teams and figuring out what is their customer looking for. And that's really what it came down to. It was very much niche.
Mm-hmm. Mm-hmm. Now, are you seeing a difference because of the fact that there's more families right now? Families with kids potentially have different F&B requirements than a business traveler, which normally you would have more of, would have. Is that helping or hurting?
It's helping in our number of covers, obviously, but it was hurting, in space requirements because families, it's kind of hard to take a family of 4 back up to the room to have a nice, meal. So for us, they're again repurposing some of those spaces, being able to provide, areas for folks to enjoy their meals was a focus, and that's something that we did at all of our hotels.
Mm-hmm. All right. Raul, how about Remington? What's been your experience with F&B?
Yeah, well, thank you for the invite. Thank you for allowing me to spend this time with you guys. In Remington, we took a stage approach about our food and beverage outlets. So if you think about the second quarter of last year was probably the toughest ones where most of the outlets were closed either by choice or by state regulations. And then after that, we began a process of figuring out property types and locations. So for example, a lot of our hotels are located near an airport or have an airline. If you have an airline crew, you have to provide certain basic services and things like that. So that forced us to have some of the outlets open because, again, it was a part of our contracting agreements. Aside from that, then we took a look at, for example, what are the basic needs of the guests would need. We found that breakfast was probably the one that came back first. On the select service side, then obviously some of the The hotels have a limited breakfast. We have a number of Embassy hotels, Embassy Suites, by brand. Obviously, we have to offer a hot option and things like that. So we had to re-engineer that. A lot of that was more of a grab and go, even though it may have been a hot meal. And then we started evaluating on our full service hotels, for example, where were they located? Some of our properties are in urban locations. And if they did, most likely you would have some outlets nearby that may be able to suffice some things for the guests. But then in some locations where you are in a suburban location where you don't have anything nearby, you have a captive audience, and those guests need to be serviced. So we looked at a very targeted approach about where it made sense, where it didn't make sense. In most cases, lunch, you didn't have anybody in the hotel. Also, we had some other things, for example, where we had specialized business, and we still do, whether it would be National Guard, whether it would be nurses and things like that. They had their own unique requirements. And in some cases, they had to have a specialized meeting room where we had all their meals and things like that. They have meal requirements. But in general, most hotels did not have lunch being serviced and things like that. So, and then after that, dinner then became an interesting one. We did have a lot more guests that started asking for it and things like that. So as I said, we had a staggered approach to it. Eventually, as we started seeing a lot of the leisure demand come in the first and the second quarter, we made the strategic decision to have food and beverage offering at every single one of our hotels. We started that process about February, March, April. By June or July, every hotel will have a food and beverage offering for breakfast and dinner. And when it comes down to meeting space, in general, we did not have as much demand. When we did, majority of that business was smaller in nature, but heavy or intense space. So you had a group of 30 that needed to be, for example, social distance, therefore they took the ballroom. We would have never done that for a group of 30, but that is the type of requirement. And because we were not displacing any other business, and it makes sense for us to use that space a little bit differently. I agree with, Ron, we actually used a lot of external space. People felt more comfortable outdoors and indoors. In the locations where we had that the weather was good enough to be outdoors, then we expanded. I mean, there's a lot of restaurants that if we had outdoor space or took over a portion of the back of the hotel, or in some instances, you would have parking lots and things like that. But we get very creative. And I think a lot of that, as I said, it was a staggered approach based on what the customer needs were at the time of.
Mm-hmm. Right. Now, did you do anything with ghost kitchens or partnering with restaurants outside, in the area? I mean, did any of that, happen at any of your hotels?
We had it in a couple cases. What did become an issue, an interesting issue, was what happens to you don't offer it, but you're getting a significant greater amount of Uber Eats, and you're getting a lot more delivery. So then delivery became an interesting exercise, because then you had a lot of people that are coming into the hotel. In some cases, for example, we would dedicate a table in the lobby where you can have kind of a drop-off, similar to what you would do in other outlets and things like that. So a delivery person would come in, leave it on the table, and then obviously we would reach out to the guests and say, this is what you have. But we found that guests felt more comfortable with an outlet, local outlet that they knew of, a local chain or whatever the case it is, and they feel more comfortable with that, as opposed to, for example, in a lot of our cases, staffing was an issue. We may or may not have had all the things that they wanted at the time. And then again, that created some other interesting things where if you had a lot of delivery from outside, then you ended up with a lot more things in the room that you need to throw away. So we found, for example, a lot more, pizza boxes and a lot more things because, to your point earlier about how the demographic has changed, families you had a lot more families. Those families tend to have a lot more, obviously, food delivered into the rooms, not necessarily from the hotel. So then you had other issues when the guests checked out in terms of guest room cleaning and things like that.
Mm-hmm. All of which is impacted by the labor issue, which we will get to, I'm sure, multiple times in this call. So that, is a good segue to the meetings and events. Everyone's kind of mentioned bits and pieces about that, how that has changed. They've been a roller coaster, it seems like, from my end of observing everything. I give all of you credit for making it through, and people are still meeting. They still seem happy about it and happy about how you're accomplishing this. But on the back end, I mean, how does it work? I mean, let's start with Raul again. You've got, the change, not only the changes, but, say, like you said, we've got a group of 30 people taking over the ballroom. That's taking up other space that maybe other people would use, or kind of limiting how many groups you can have and things like that. How do you still make money out of that?
Great question. Reality is that you're not displacing a lot. You don't have 150, 200 people meetings right now. And some of it is state regulated, some of it is county regulated. So you're not getting currently into an issue where you are displacing better business, right? I think that we have, as part of one of our sister companies is JSAV. We partner with them and actually launched at the end of January hybrid meetings by Remington. As a matter of fact, we have done in the last 4 months, our staff meeting has been a hybrid meeting where we have had at one of our hotels 40 associates in person, and we have had an additional 30 or 40 associates being remotely. What has allowed us to do is to have kind of these internal process where we evaluate how does a guest feel, how does a client feel, how do we do transitions between panelists and things like that, similar to what we are doing here. And I do believe that hybrid meetings are here to stay. I think that when you have that a number of associates now have gone from being in an office to working remotely in a Zoom town, then you're going to end up with a situation where those associates may never be able to travel or may not be able to travel the same frequency, and they still need to be part of the environment. So I think that's one of the things that we have to, as an industry, reimagine our space, that we are not, as an industry, limited to the physical plant of our hotel. We have to think higher to say, we have an event that is taking place in our building. However, that can expand beyond our walls. And we haven't necessarily been in the business of audiovisual, but it is something that we have to start thinking about. As, for example, you have some clients that are going to require an event that they need to sell tickets for. Does that become a revenue share? Because we are providing the technology for it and things like that. So I think we have to reimagine. I mean, I will tell you this year I have been part of 2 Zoom baptisms. I have had friends have had Zoom weddings. Why? Because you cannot travel. They still need to be baptized, and you're getting what used to be a few years ago. Well, let me log in on an iPad and show it on Skype. Well, reality is that it's happening more and more. So you are going to have people that are not going to be able to comfortably travel for the next 2, 3, 4 years, and we still have to have a technology that allows us to solve for it. And if we don't, I think that is going to become a competitive disadvantage.
Mm-hmm. Jen, I see you nodding your head to a lot of that. That's what you're seeing.
Yes, very similar to what Raul speaks of. Over the last 16 months, we actually took this opportunity to understand how this cultural change is going to affect the buying habits of our consumers. So as the meeting planners and event producers come back, we don't think that hybrid is going anywhere. To his point, it's going to last for a very long time. So we've developed tools and resources. We've collaborated with our AV partners on a national basis, and in the US delivered toolkits to aid our hoteliers in understanding the language, the differences between the types of virtual, hybrid, or broadcast studios. So that way they can, again, partner with the AV team to execute on behalf of the event producers. In a lot of markets, it may be our hotelier that's educating the meeting planner itself to make their first one out of the gate successful. But it's not only the space, but it's the AV that's driving the entire experience. And we look beyond the ballroom and beyond the hotel to incorporate the two. And the other thing that we've done to ensure that we're maximizing space at Aimbridge, we've partnered with the WELL organization, and it's a third-party certification. We have over 300 hotels, and it's continuing to grow on a daily basis, of hotels that are WELL certified. So again, that drives the consumer confidence that not only can they come meet in our hotel, but use every aspect of that square footage in a very safe environment. And the WELL certification goes through every aspect of cleaning and sanitation, obviously the hot buttons of the last 16 months, but also the preparedness of our emergency plans, of our operations, and different elements to, again, have that third party to drive that consumer confidence. And then I think the third element that we really need to focus on as an industry is celebrating these large events that are taking place. As we've been talking about on this panel and as we heard throughout the day, small events are starting to come back. But it's these large events that are going to drive the increased business. And whether it's professional sports or whether it's Vegas that's now celebrating their first citywide and large-scale trade show, we need to, as an industry, celebrate these successes and, again, work those and educate our event producers, our target audiences to ensure that it is safe, that our protocols are adapted, and that we're ready to welcome our folks back. In a hybrid situation if it's required, because again, we feel as though that isn't going anywhere, but certainly in person at our hotels.
Now, you talked about thinking beyond the ballroom. Will this change hotel design going forward? I mean, when someone goes to build a new hotel, is this going to change, we'll get to outdoor in a few minutes, but that's been mentioned, outdoor, the different types of meetings, the different sizes. What are we going to see in hotels?
I think you're going to see, as we've experienced in the last decade, all of the major brands and all of our partners have focused on the lobby experience and activating those public spaces. But as neuroscience shows us, when our attendees are exposed to natural light, to untraditional meeting space, it certainly grows in their retention, in their engagement. And I think those benefits were highlighted this year and will continue as we go forward. So I think you will see an impact on how hotel design is developed going forward. Again, with the F&B element that we started on, those activations and those outlets are going to be a bit different. We may not have a consumer that needs 8 outlets on a hotel that's a large complex hotel. They may be scaled down, and that may lend to additional non-traditional space. So it really is adhering to how the modern guest wants to learn, wants to retain, or wants to engage in the events that are taking place in the atmospheres in our hotels.
Mm-hmm. And some of that might take a little while to really shake out. Okay, great. Ron, what about you? What's going on with meetings and events? Are you anticipating changing any of your spaces to something else that will make you money?
And I agree with Jen and Raul on all their comments. Flexibility, I think, is going to be the key. Early in this, it was all about communication, and I think to a point it still is, and I don't think that piece is going to go away, whether it's our hygiene standards or how tech is going to serve hybrid. I agree with Jen. I think hybrid's here to stay. I think it's going to allow the end customer maybe to expand some meetings, and I think we need to help them understand that, whether that's across the United States or across the globe. But another thing we looked at across our hotels, and it was a little eye-opening, was how are we digitally showcasing our space? And we really made some advancements and picked up some partnerships so we could digitally showcase our space to the end customer. And I think that was really well served for us. That was probably one of the bigger rocks that came out of this. So that would be, my big things there. We saw a little bit more usage because we could cut sessions down shorter, mostly because they were smaller. So where maybe we had one large group in for a day, we could get 2 smaller ones in. Not revenue as the larger group, but trying to maximize that space as much as we could was a focus for everybody.
Mm-hmm. Okay. Now this outdoor space that we keep touching on, that has been huge, not only for hotels, but just regular people in their homes, in restaurants, all along the street, everywhere. It's been the buzzword. So, Jen, let's start with you. What did you do? How did you, pivot to this? Did you already have outdoor spaces, or did you have to build them? I mean, where did this all come from, and will it, continue going forward?
Sure. So obviously science throughout the last 16 months has shown us that outdoor space is one of the safest spaces to meet. And again, to build that consumer confidence, to ensure that our clients are comfortable meeting, we've encouraged our hotels to redesign their outdoor space. Many of our full service luxury hotels had different outdoor venues, but we encourage the other teams to walk the property and look and understand how they can merchandise their outdoor space differently. And we've had great successes in using patios, in using gardens, rooftops, bringing in food trucks, and doing things innovatively and creatively. So whether it's a corporate group doing a games and grays outdoors as opposed to your traditional reception indoors or in a ballroom previously, to a social engagement doing an I Do barbecue or doing something outside that really harnesses that safe environment, it's been of great success. And a key to that is merchandising it and ensuring that you're marketing it correctly and understanding while we may have lost square footage to social distance over the last 16 months, we certainly have some innovative opportunities to use some outdoor space. And I believe that will continue to go forward.
Now, if we could only control the weather to work with us on these outdoor events.
And seasonality and some market.
Yeah, definitely. Well, here in Cleveland, we get made fun of because we love to go outside in all temperatures and, cook out even when it's snowing. So I think if you have any hotels here in Cleveland, you're set. Ron, how about Real? What's the outdoor ethos right now with you?
The major focus for Real when we really looked at it was there again, finding that creativity and what can you do, and taking those smaller spaces and creating an outdoor area where it's small plate. We had a property that just focused on that, so they took an outdoor area. Wasn't large, it only served about 12 folks, but we focused on a cuisine and a small plate aspect, and it really worked very, very well. And it's using every inch of the property. I agree with Jen. We did that at a lot of our properties. It's just even our select service hotels walk that space and figure out what it may be, because the good thing out of this was you weren't looking for a space for 50, right? If you could find a space for 10 or 12, in a lot of instances, there was some sales that could be made there. So really looking at every part of your property. And then when you found something, how do you build off that? So if you took this and you could use this space for 12, as we come through this, can you take it from good to great and expand a little bit more, and maybe it serves 20 or 25? That's really what you want to focus on and see what the outcome is from using those spaces.
Mm-hmm. And you've already got the dishes, you've already got chairs, you've already got what you need to move out. It's an easy thing to just, relatively easy. I won't say any of this is easy, but It's relatively easy to shift that where you need it to go.
Yeah, and you touched on it earlier. Labor challenges makes it a little bit tough, right? Especially at some of our larger properties. When you start spacing out events too long, you start calculating that travel time, and it adds up quickly. But you just have to work. You have to work through each one. And as we said before, you kind of change the game book every week as we work through this pandemic.
Mm-hmm. Now, Raul, I think I heard Sloan Dean yesterday talking at NYU about switching about I think it's a 3-pronged plan for meetings and events at Remington and part of that is making sure people know what's there, and in addition with the outside and all of the different elements that you have. So how are you letting people know about your outdoor elements and what they have to choose from?
Well, so a couple ways. We have all seated as an organization that we're able to do different setups and things like that virtually. We have another company that we're working on 3D, so we're able to show that. But the reality is, if you really think about all the new space that has been temporarily created, none of it is photographed, none of it is in our square footage and things like that. I think a lot of that we are communicating through our sales effort, and we have a very strong team. We have a very we have seen in the last 28 days is the most amount of new leads that we have received since the pandemic. So we are seeing a significant increase in new lead volume, and we also have a very heavy focus in solicitations. So a lot of these information needs to be communicated in person or via phone or via email. And every time we have an opportunity to have a unique event, then we try to photograph it, we try to have it available to us, because again, every one of those situations is going to be unique for us. What I would tell you, it's been interesting for the outdoor space because it's all about the ambiance. So we have had to come on into a space, whether it was a small patio, whether it was grass, or whether it was a parking lot, and now we need to figure out how do we make make the space feel a little bit more warm. Corporate business is probably still going to be, it traditionally has been kind of in a traditional meeting room because there's probably presentations and things like that. On the social side is where you're seeing a lot more of I prefer to be outdoors. And again, for that, we have been looking at, for example, what happens to the flooring, right? Do you build a temporary deck, or do you actually have tarp, or do you have turf? I mean, there's a lot of these elements. What happens to lighting? A lot of these have become very interesting for us because we saw it from the restaurants. We went out to restaurants. Restaurants started expanding to the streets, expanding to the walkways and then the streets and closing streets. So we found a lot of ideas from, again, independent operators who said, well, I think I can probably pay for, the street parking and rent it out to the city, right? So that became, that whole trend then allowed us to think differently, to say, okay, I can carve out the space, and now I need to soften it up to look more like a leisure location, whether it is with, Texas lights or warm lights or whatever the case it is. But we have all become designers of our own hotels, which is going to be an interesting a trend that we would look at in the future, because these allowed us to do two things. One, to be creative with our space, but two, to accelerate our deployment. In a prior year, it would have taken us 6 to 8 months to think about it. Now we've had to make decisions pretty quickly, because likely is that we had a lead that came in that said, you know what, I need lunch for 100 for a wedding, and you need to figure it out. We've had to make a lot of decisions on the fly. And I have to say that our teams on the field have been unbelievable at figuring out ways, how do I do not just whether it's a hybrid meeting or whatever the case it is, but how do I, for example, create COVID bubbles? That has been a very interesting thing, which is you have a company that wants to do a meeting. They don't want to be exposed. And this is probably 6-8 months ago was more common, that how do I ensure that their travelers are not going to be exposed to the clients? And we've done that with a number of hotels in terms of buyouts. We've done that with a number of hotels with, again, sports teams and things like that. Because, again, a lot of these things we wouldn't have considered in the past, and now it has allowed us the opportunity to explore some of these things. So I do think that I'm very excited about the things that are coming out of it as we reimagine our space.
Mm-hmm. I think that will be exciting to watch. So then our last question, Ron, we're going to start with you. You can't make a space work if you don't have the right people or enough people and the right supplies. And both of those are kind of issues right now. So how are they affecting your ability to get as much revenue as possible out of your spaces? And how is this going to affect going forward?
Well, for us, we'll start with the people side of it. Obviously, cross-training and those associates that can perform various jobs were like gold, right? So if they could perform various jobs, whether it was on the room side and F&B or throughout F&B, was a key savior. So we focused on that and focused on teaching those skill sets that could be taught, whether that's from the banquet service side or not. So that was key for us. Tough, just getting enough of those individuals, I think, was the most part. On the supply chain, I think it was, it's tough. It's still tough today on the supply chain side. So really looking out at different partners, we looked at all the different businesses that we're involved in and tried to find alternate resources to get the similar or the same supply that we needed. And it mostly came in the non-perishable. The food wasn't the hard to secure. It was a lot of the other things that came along with it. And that was key. We looked at that and we came up with the distribution plans where, in certain areas, we even, looked at sharing from one hotel to another if we had it in a close proximity, because it was very niched out. There were, some areas that, even within New York City, where we have a very good supply of hotels, you had different business levels in Brooklyn than you had in downtown or in Midtown. So that was key. And it was really managing a lot of moving parts. That's really what it came down to.
Mm-hmm. Okay. Jen, people and supplies.
So I will echo every point that he just made. It truly is a challenge, and it comes to innovation in cross-training, and then cross-training not only our individuals in roles, but across properties at Aimbridge. We're truly blessed that we have a number of hotels in like markets or similar markets or geographically very close to each other. So we're taking the best of the best and training our associates and investing in our people to understand what roles they can take on across the property to achieve the service delivery that we're looking for. We've also partnered with a number of trade schools, as well as looked at, in the event and meeting space, looked at other partners who historically have provided guest service, whether it's a DMC or whether it's a decor partner. But those elements obviously are critical in a smooth execution of an event, from the atmosphere to the engagement and everything else. And some of those individuals, those businesses may have gone by the wayside. Those individuals may be available. We tap into those resources in the various different markets. So it's really a collaboration on behalf of our industry to ensure that we can bring in talent and use them where it's appropriate to ensure that we have a smooth delivery. And then truly investing in our people and expanding their skill set. And again, it may be a front desk worker who then becomes a server in banquets and so forth. When you get down to the brass tacks of things, it truly is a peak and valley scenario that's happening in many of our hotels until it stabilizes. So how can we invest in our people and grow them to expand their skill set to achieve what's happening until stabilization? And a lot of creativity and recruiting.
Mm-hmm. Yeah, I think that will continue.
Yeah.
Raul, take us home.
And the elements that we've learned over the last year from contactless service and things like that will certainly not go away either. The integration of tech will aid us in some of those labor shortages. Again, whether it's kiosk or online ordering in an F&B aspect, whether it's online registration, mobile check-in, concierge services, and things like that. The consumer certainly is more accustomed to it than ever before. And so those touch points have changed, which again will help us in redesigning service delivery and how we allocate the labor to achieve that.
Yeah.
Mm-hmm. One of our panels tomorrow is about technology. So I'm really excited to hear about what to expect and what's coming. So that's a very good point. Thanks.
Touchless technology goes, I think, is going to be something to watch over the next 12 to 18 months. I think it's going to expand not only in our industry, but I think everywhere. So watch that.
Mm-hmm. Sounds good. Well, thank you all so much for your time today. This takes us to the end of day one. You've had great insights, and I've enjoyed talking about it. And now we go back to Amy.
Thank you all for joining us today for Hotel Optimization Part 4. Thank you also to our panelists, our sponsors, and AHOA. We hope to see you tomorrow at 10 a.m. Eastern for day 2 of our program. Have a great rest of your day in the meantime.